All right, everyone, welcome to the Market is Changing Masterclass. So the market is changing. Now what? It appears that this is something everybody is really interested in because we have quite a few people registered for this masterclass. We'll see how many show up, but we're going to have a good time nonetheless. And I'm not going to wait on them. We are going to get going. It is 1803 Central Standard Time. We're not on daylight savings anymore. And believe it or not, 1800 is not military time. That is global time. We're one of the only countries in the world that actually uses a 12-hour clock, which is why when you go to an airport, train station, places like that, all you see are 24-hour clocks. There's a reason for that. So that is neither here nor there. Let's get started. Let's get the technology working here. There we go. So let's start off with a little disclaimer. I am not an attorney nor a CPA, and I do not play one on TV or pretend to be one in real or imaginary life. And yes, I do have an imaginary life. Just ask Sean. This material is for educational purposes only and should not be considered advice. Consult your own attorney and or CPA for such advice. All right, that's the legal stuff. So let's move on. What are we going to talk about today? Well, we're going to talk about current economic conditions. And I'm going to go into exactly where everything is sitting right now as it sits, as ballots are being cast all over the country in this election evening. Thank you for joining me instead of watching that junk on TV. I commend you for that. Good job. And during current economic conditions, I'm also going to go into an update from Casey Conway, who is the chief economist for the CCIM Institute. We had a breakfast with him when I was in Chicago on October 15th. So we are going to go over a summary of what he talked about. I've got some of his slides that I've put into my presentation here to kind of show you what he sees that's going on right now, and we'll kind of compare that. Then we'll talk about the real estate market cycles and their definitions. A lot of people know what phase 1, phase 2, phase 3, and phase 4 is, but what they don't know is what do those phases truly mean? And what are the solutions when you're in those phases? So we're going to take a deep dive into that, and that becomes really important, especially when we talk about phase 3, which is where we are currently sitting in most markets right now. Okay, then we're going to go back to the basics. Okay, a lot of you that have seen me talk before, have seen me teach, or are in the strategic partnering community, you know I talk about underwriting fundamentals and assumptions a lot. Well, they are the key to getting your underwriting done today. So we're going to go over them again and talk about why they are so important, especially today. And then, now what? So we'll summarize everything on what we'll do moving forward to get us through what's coming. And we'll talk about that in a few minutes. So really fast about me, I don't give you a big origin story like people do and spend 30 minutes talking about themselves. You don't want to hear about me. I'm not that good looking of a guy, although I gotta be honest, that is one of the best pictures I've ever taken. I did that on Saturday when I was in Chicago this last October, or just last month on, I think it was the 15th. So I am a multifamily investor and a strategic consultant. I am a CCIM. Those of you that don't know what CCIM is, that is a certified commercial investment member. I am one of only 60 instructors for the CCIM Institute. We have over 13,000 members. We only have 60 instructors. If you want to know how good the CCIM education is, 135 universities across this great country of ours utilize the CCIM education as the curriculum for their real estate MBA programs. And I am very proud to be an instructor for that curriculum. I teach 102, which is the market analysis part of the curriculum. I'm also on the CCIM Tech Board. I am actually the vice president this year. We're holding elections next week for next year. No, I'm not running for president, but I will be running for VP again And I was just reelected to the tech board while I was in Chicago for another 2-year term. I'm also on the CCIM Foundations board. Next year will be my last year on that. I am not going to renew on there. Just too much going on with me and CCIM. And next year I will be the CCIM Ward Center Committee Chair, which means I have to be part of 3 other committees because of that chair seat. So that wasn't something I was looking forward to, but I kind of got asked to do it and I did it. I'm the founder of the Strategic Partnering Community. I'm a former syndicator and now passive investor. And I made the mistake of owning a property management company at one point. What I did learn from that, I owned it for about 20 months, best education I've ever received, ever. But what I learned from it was that there is a profession that has lower margins than restaurants, and that happens to be property management. So be very careful opening a property management company. The way to do it correctly is to own thousands of units, get that scale, and then bring your property management company in-house. That's the way you do that. Can you contrast global versus US versus state and local economics? Well, let's see when we get there, Sean. Ask a more direct question as we start talking about it right about now. So let's look at what's going on in our current economy. So I pulled these right after the bell today. These numbers are as they sat at about 16:15 Central Time this afternoon. So how to control inflation. We already know this. The inflation number from September was 8.2%, and it had a 0.4% month over month. Now, on an annual basis, year over year, in August, it was 8.3%. So you saw a 10 basis point tick down on the year over year, but we saw a 0.4 increase month over month, which was the big deal. The big deal wasn't the tick down of the year over year. It was the month over month, and that was not expected. And of course, that's when the stock market really went down. Of course, the last couple of weeks, it's managed to bring itself back up, kind of like it normally does just before CPI comes out again, which is in 2 days. So we will see. There's no guidance. We don't know where it's going to be, where inflation is sitting 2 days from now. So 8:30 Eastern time on November 10th, which is the Marine Corps birthday, for those that don't know, the day before Veterans Day. Keep an eye out for the new CPI number. The important one is that month over month. Okay, then the next Fed meeting where they raise interest rates again is December 14th. There's talks. They're going to be somewhere around 0.5 point and 0.75 point. I'm going to throw politics in here just slightly, and then I don't want to talk about it again. I know ballots are being counted right now. And on the West Coast, they haven't even closed polls yet. But I believe in my heart of hearts, and this is really an educated guess, that the Fed has been tiptoeing around raising rates until the election. Well, election is now done. And so I believe in December, they're going to go aggressive. And no 0.75 basis point is not aggressive, or 75 basis points, 0.75% is not aggressive. That's tiptoeing around. They need to get aggressive. Okay. So that's what's going on with inflation. Because of that, the Fed is raising interest rates. The interest rates were raised a week ago, or was it 2 weeks ago? Doesn't matter. They raised it to 4%, another 75 basis points from 3.25 to 4.0. The prime rate, which is typically a 3% spread from the Fed rate, and I did go look. So the Wall Street Journal prime rate right now, which your best borrowers, single family homes, they can get 7% interest right now, which means that your loan, if it's a 30-year fixed FHA, you're looking at least 7% to buy a house right now. We'll talk about that affordability problem here shortly. And then Freddie Mac, which is our number one go-to for multifamily, and they publish a solid number every single week. As of last Thursday, they are at 6.95. They actually came down 13 basis points. They were 7.08 last week, so they ticked slightly down. We anticipate that's going to go back up again this week. The 10-year as of today was sitting, as of 16:15 this afternoon, was sitting at 4.13, the 2-year at 4.66, and the 3-month at 4.22. Now, what does that mean to us? Well, interest rates are tied to cap rates. I know you haven't been seeing it yet. CoStar has. There's an article I'm going to put up for you guys here in a little bit that talks about, for the first time, quarter over quarter, we've seen a decrease in asset prices in multifamily and an increase in cap rates. So the numbers are showing up. What happens as an investor, and we'll talk about this in a minute, is as cap rates are increasing, property values decrease. We know that, but why are they increasing? It's because when you get a rate from your lender of 6.95%, in order to be able to get the benefit of that financing, we like financing because it means we don't have to bring as much capital to the table, so that us and our investors can get a higher rate of return on the asset. That's called leverage. Well, when your cap rate, your going in cap rate, not the market cap rate, your going in cap rate, what you're paying for the property on the existing financials, not some stupid pro forma, on existing financials, what you are paying for that property with that cap rate, if that cap rate is lower than your interest rate on the loan, that is called negative leverage. You're going to get a lower rate of return than if you would have paid cash for the property. Okay. So that's why cap rates increase as interest rates come up. Now, there's a lot of student syndicators out there. I call them anybody that's been syndicating since about 2016, 2017, I call them student syndicators. And it doesn't matter what community they're in. I'm not going to bash one community over another, although Sean knows I like to bash one in particular. They are still buying at cap rates lower than their interest rate, but I think they're finally starting to come around. We're starting to see some loan assumptions hit the street again. So people are starting to pay attention, and things are starting to come back around the way they should. And we'll talk about how you purchase these here in a little bit. All right. So if that going in cap rate is lower than the interest rate, that means you have negative leverage. All right. So what's this mean for you? Well, that means that right now is the best time to educate yourself. There aren't a whole lot of good deals out there right now. There is still a huge disconnect between sellers and buyers. The sellers still believe that they have a 4 cap on their opportunities, and the buyers know it needs to be somewhere closer to 7 or 8% in order to be able to get that positive leverage if they're bringing in new debt. Okay, and we're going to talk about the type of debt that's going to be very important moving forward when we get to market cycles. So the education doesn't have to be for me. Yes, I provide education. Everybody knows this. You just need to get educated, because when this market does realign itself, and it's in the process of doing that now, it's going to accelerate in the first and second quarter of 23. I think you're going to see. So if you get educated now, get the gaps that you need in underwriting. If you've been underwriting the way the gurus taught you to underwrite on a pro forma, you need to go back to the fundamentals and pay attention to what I talk about at the end of this, because if you're up underwriting in a pro forma right now, you're setting yourself up for failure. The market can't handle it. And with asset prices going down, and for the first time since March of 2020, rents are decreasing in the Sun Belt. Yes, Texas, you too. Article on it, and I'm going to provide you the article here in a little bit. You don't have to purchase the deal to get paid. That's another thing that you can do right now. If you get involved as a strategic partner or get an acquisition fee, or you've got the ability to bring capital to the table and get a portion of the acquisition fee, You don't have to purchase the asset. You can just be part of a team. Make sure you've got those good, sound underwriting fundamentals, especially if you're bringing investors to the table. But it doesn't mean you have to purchase the deal to get paid. You can do it as a strategic partner. My community, the strategic partnering community, the strategic partnering workshop, we go into great detail on talking about how to do just that. So if you don't care what the underwriting is because you just found the deal from an owner that wants a stupid price, and you go to one of these student syndicators and they're willing to pay that stupid price, heck, hand it off to them, get a half of the acquisition fee and call it a day. At least you got paid. Let him worry about the operation, or her worry about the operations of it. All right. So next, we need to understand and follow the economic data. Okay. What are the jobs doing? More specifically, the basic jobs. What are interest rates doing? What's inflation doing? Treasuries, and how is that all affecting cap rates? All right. A lot of people, especially in Texas, when I talk to them about how there's going to be a decrease in the rents, they all tell me I'm crazy because the demand is so much greater than the supply for apartments in Texas, and that people are continuously moving to the market. Jobs can keep coming to the market. And I would agree. But as you're going to find out in this presentation, and I'm going to show you the numbers, and the chief economist of the CCIM Institute agrees with me, we have hit an affordability apex. I've been warning people for 9 months, pay attention to the median household income. I've been ignored for 9 months. Well, now the renters are starting to talk. So now we have all these units that are still hitting the marketplace. And again, I'm going to put an article in the chat box here in a little bit. CoStar was talking about this directly. We have all these units still being poured into the marketplace. And there's been a 40% reduction in absorption quarter over quarter because the renters cannot afford the rent increases anymore. Okay. We've hit the affordability apex. I'll talk about that a little bit more in a little bit. All right. So what does Casey Conway, the chief economist of the CCIM Institute, have to say? So the next few slides were all his from the breakfast that we had on October 15th. All right. So CREPI. CREPI is the Commercial Real Estate Performance Index. You can see over here that there are 10 indexes that it takes its data from. The University of Michigan's Consumer Sentiment Index, NFIB's Business Confidence Index, the yield curve spread between the 10 and 2 year, the National Association of Home Builders, Wells Fargo Housing Market Index, the Bureau of Economic Analysis Personal Consumption Expenditure Index, Bureau of Labor Statistics Producer Price Index, the BLS Job Openings and Labor Turnover Survey, the BLS Civilian Labor Force Participation Rate, which ticked down again today if you were paying attention, the S&P 500 Index, and Green Street Commercial Property Price Index. It takes all of these into consideration. And you guys can't see it very well, but since 2000, and these are on, it's either a quarterly or monthly basis since 2000 or 2010, might be 2010. No, it's 2000 because here's 2009. We've got what the commercial real estate performance did based on this indices. Okay, this is one of the most accurate sentiments of what's going on in commercial real estate. You can see that in March of 2009, it dropped all the way to 84.2. So you know the benchmark for this, the kind of zero line, is at 100. And that 100 occurred, I think it was this point right here or this one right here. It was December of 2019. That's what they used as the benchmark for this index. This index was created in the first quarter of 2020. So you can see that in 2020, we had this dip, and then we had the massive dip when everything shut down. And of course, it came back. But if we look at where it was up here, and I think it was 90, we'll see it on the next page. It was 99 something or 98 something at its peak before the drop. Then it precipitously in September started to drop. 91.7 in September 2021, 90.1 in 2022, January, and then just tanked all the way to 82.4 in July of 2022. It ticked up 0.7 points from July to August. We don't have the new numbers yet for September, so we don't know if that's coming back down or if it's still trending upwards or not. We'll have to wait. 1 month does not create a trend. We need 2 or 3 months to get there. But we can see that it is well below the March 2009 of the Great Recession. So we are well below that for the commercial real estate performance index. So what does this really mean? So if we look at pre-COVID 2018, 2019, GDP was around 2.9, 2.3 for those years. Fed fund rate was about 2.5, and then it was lowered to 1.75. Not really sure why it lowered during that time. Oh, because, well, no, I don't know why it lowered during that time. Inflation rate year over year, 1.9 in 2018, 2.3. First time we saw it go above 2 in over 10 years. Then 2020 hits and we went down slightly because everything was just absolutely shut down. Nobody was buying anything. And then we get into 2021 and whammo, we start to climb precipitously. Going into first half of 2022, we were sitting at 8.3, still around 8.2, 8.3 right now. Coming into the 10-year treasury, we can see that the 10-year treasury was decreasing, much like the Fed fund rate was decreasing. And then 2020 went way down, and then it started its climb up. First half was 3.57. Now we know we're close to 4.3 or 4.2 now. Labor participation rate has continued to go down and got up to 63%, but now we're even less than that as we start to head down again. Fed balance sheet, they were supposed to be reducing the balance sheet. They have continued to increase it. There has been no reduction of the balance sheet. This is trillions. This is in millions. Okay. So add 6 more zeros on the backside of this. So this is 8 trillion. So they did not reduce the balance sheet like they said they were going to do. CPPI has come down tremendously just in the first half, which has got our CREPI at 82.4. Okay. So when we look at this, you can see that inflation occurred just like it did up here, but that flexible CPI, and we're going to cover flexible CPI here in a little bit. That's the inflation for housing, was affected more than just about anything else. So we can see in the first half of 2022, the flexible CPI was 3.52. In 2021, it went all the way to 20.69, but you can see where it's even higher than that here in just a minute. So this was all a whiplash of what happened because of what happened during COVID and the amount of money we put back into the marketplace again. So this was something very interesting that he talked about. In case you haven't noticed, there's a drought going on in the western part of the U.S. This drought is causing our housing in the market to have to labor their water usage. It's affecting crops and it's affecting a lot of things we do. One of the biggest crops that's been affected by this has been wheat. There's a huge, massive wheat problem, and we know that wheat affects a lot of things we buy at the grocery store. So one of the reasons we're seeing inflation so much at the grocery store, especially for food items that deal with wheat, is because of the drought going on in the West. So when we look at this, if you look at Wyoming and how GDP has been affected by the drought, we can see negative 4.8%. Okay, this is in Q2 of 2022. Wyoming was negative 4.8, New Mexico negative 2.3, Arizona negative 1.9, and Colorado negative 2.0. Okay, So you can see Nevada, of all the Western states, Nevada and Washington were the only two positive GDP during second quarter 2022. Pay attention to this because this is going to get worse before it gets better. And this is going to exacerbate what's going on in the economy that a lot of people aren't paying attention to. All right, so here we're talking more inflation. So why was it flat a little bit from second quarter to third quarter? Well, if you remember, the federal government released oil reserves. When they released the oil reserves, that allowed energy costs to come down, okay? So who knows what happened with those oil reserves 9 days ago on October 31st? Does anybody know what we did with the oil reserves on October 31st?
They sold them.
We stopped tapping into them. So pay attention to energy prices. They're not being affected yet. I just looked today. Oil actually dropped a little bit today. It's down to $82 or $83 a barrel. But from what Casey was saying, and this is a little over my head, but from what he was saying, that because of us using those reserves, that allowed energy prices to come down. That started to flatten out inflation. Now that we are no longer tapping into that, give it a month or two, and we're going to start to see inflation start to tick back up, probably at a greater rate than we saw before, because energy prices are going to start to go up again, especially after the election. So those are from his words. I don't have the smarts in order to dig into the data that much. I am not an economist. I'm just relaying to you what he said is coming based on what he sees from this. And he's one of the smartest economists I've ever met, but I'm biased because he is the economist for the CCIM Institute. So flexible CPI. Flexible CPI is the offsetting prices for food, wages, used car prices, things like that. When it was at its worst in March of 1980, if you guys remember, well, some of you that are old enough, Sean, in March of 1980, inflation was around, real inflation was around 12, 13, 14, 15%, somewhere in there, causing interest rates to go well above 18%, in some cases up to 21%. Yes, people were buying real estate at 18 to 21% in the early 1980s. Well, if we look at what happened in March of 2022, we saw a 25.1% in the flexible CPI that nobody is talking about, okay? We can see here its peak, from its peak in 1980 to its peak in March of 2022, right? So pay attention to this. I don't really know how or what this means to us moving forward. I'm just relaying that Casey was very adamant about this being a major indicator of some bad stuff that's going to start to happen, and how, especially in housing, because it has to do with energy, it has to do with food, wages, car prices, things like that. All right, stuff that we need every single day. So pay attention to the flexible CPI. This was an index that was created by Arthur Okun back in the early 70s. He called it the misery index. So the US is the black line, Europe is the gold line, or US is US is black, Europe is gold. Okay. And basically what this means is we get to certain situations where things just get miserable. So they just dubbed it the misery index. So the new misery index adds, and it's different than what it was in the 70s. In the 70s, it was just annual inflation and employment and unemployment, okay, dubbed stagflation. So when inflation was high and unemployment was high, that meant you had stagflation and the misery index was way up. But if we look at it now, they've included subtracting GDP growth from that and the annual increase in the S&P 500. So now It is adjusted, so you kind of have to take that into consideration. It's not really apples to apples. But again, Casey was really concerned about how the misery index is tanking up very precipitously from what we've seen in the past, and getting bad situations from that. So just another indicator of what's going on. Now, let's talk about affordability. So what's up with housing? And this is Casey's, this isn't mine. I've been talking about this for a long time. It's not just inventory, and I've been telling you guys this. We're not going to run into a supply situation because of demand. We're going to run into a supply situation because of affordability. If we look at interest, we can see that just in, let's see, what did he use for this? Just this year, in the last 12 months, we've doubled in interest rates. Mortgage payments and a median home price went from $1,500 a month to over $2,500 a month in 2 years. Median home sales, 300,000 to 430,000 in less than 2 years. Okay. Look at it in 2012. Median home prices were around what's that, about 147. If you go back to 2010, it's down to like 127. We have tripled in home values since coming out of the financial crisis in 2008, 2010. This is where multifamily is going to suffer. It isn't going to be demand versus supply. It's going to be affordability versus supply. So here was a article by CoStar. I believe it was Thursday or Friday. No, Monday or Tuesday last week. I put it up. May have been this week. Things are rolling faster than I can go. Multifamily rents retreat as supply overwhelms tempered demand. Sunbelt markets that led rent growth last year now see the fastest decline. Pay attention to this. Brokers are still telling you, oh, you can get $200 or $300 rent bump, you purchase this property. Oh yeah? That's not what the numbers are saying. Okay, so I'm going to paste this article in the chat box. Let me make sure that's the right. Nope, that's not the right one. Hold on a second. That's the wrong link. Let me grab it. Move that out of the way. Copy, paste. Okay. So there's the article on rent decline. Next, quarterly apartment prices drop for the first time since the start of the pandemic. So quarter over quarter, first quarter to second quarter 2020, we saw prices drop. I think that was primarily due to everything just kind of stopped at that point. Now we're seeing quarter over quarter for the very first time, because of the interest rates increasing, prices in apartments have increased. Okay. And so cap rates are going up because interest rates are going up. Those that are still paying attention and can find an opportunity that works, they are still buying, but they're buying at higher cap rates. Sellers are fighting tooth and nail, but the sellers are losing. So it's only a matter of time before we get on the same page. Okay, so here is the link to that article in the chat box. All right. So that's what's going on in the market right now. So let's talk about real estate market cycles and what that means to us as we sit here today. So sorry about the dogs barking in the background. Nothing I can do about that. So we all know the 4 phases, or at least most of us know. If you've seen me in any kind of market analysis class in the past, you know phase 1 is considered the recovery phase. And that starts in the lower left quadrant. Then we go up to the upper left quadrant into phase 2, or expansion phase. And then we go into phase 3. That's now your upper right quadrant, into oversupply, and then into phase 4, recession. Okay, that's great. Those meanings or those words for the explanations of those phases, that's great. They give us a snapshot, but they don't really tell us what's going on. So I'm going to actually go in and define what each of these phases actually mean and the solutions in those phases so that you can survive or thrive depending on the phase of the market. So let's take a look at this on the market cycle chart real quick first. So we have phase 1 recovery, phase 2 expansion, phase 3 oversupply, phase 4 recession. So coming out of 08, 09, we were sitting right here and we start to climb up. So at this point, we have probably still have declining rents, maybe stabilizing out right now. We may still have a little bit of increasing vacancy, but then as we start to level out and come up, our vacancy is starting to decrease a little bit now as occupancy increases. We continue up. Now we may have some slight rent growth going up even further until we get to that long-term occupancy average. So below the long-term occupancy average line for the market, and no, 96, 97, 98% is not the long-term occupancy average for the markets that you're seeing right now. That is an anomaly. Most markets are somewhere between 85% and 92 or 93% long-term, 20, 25 years of data to get your long-term occupancy average. So if you're below that line, you're down here in the recovery phase. Once, and this is considered the net operating income. So as rents are increasing and as vacancy is decreasing, our NOI is increasing, as long as we're not in an inflationary environment causing expenses to increase greater than our income, which, believe it or not, even though people will tell you otherwise, did happen in 2021 to a lot of properties, even though they didn't account for it. So as we get over into the expansion phase, now rents are really starting to rapidly rise. And excuse me, the occupancy levels are getting closer and closer to that 100%. Now, we don't ever want to be at 100% or our rents aren't high enough. So we're finding that equilibrium point. Once we get to this green point, so our NOI is high enough where rents and expenses, rents are high enough, expenses are low enough that we can afford new development, new construction starts. So this started around 2014, 2015 for multifamily and has been going gangbusters ever since. As we continue to go, new supply starts to hit the market. We got a bunch under construction. New supply starts to hit the market. And as supply meets demand, we hit equilibrium. This is the most we can do in a market. This is that top point, the top of the market, that one point everybody tries to time. We can get here and we can get here. We can't ever pick here. I can tell you that across the United States, we hit this point right around Valentine's Day 2022 in just about every market in the country, because we've all been kind of stagnating right around here for about 2 or 3 years, back and forth between oversupply and expansion, oversupply and expansion. Well, I'll tell you, even though you're going to see in second quarter 2022 that Dr. Muller's report is going to show you most is over here still in expansion. Actually, it's at an equilibrium. I'm going to tell you that past that, beyond that point, remember, March 31st is the end of that first quarter. June is second quarter. Our equilibrium point was February 14th. I'm just calling it Valentine's Day. It's just a good, was it that date? No, but it was right around that time. It's a good time to say about Valentine's Day, we were at equilibrium and we've been going down since. Okay. So as we get into oversupply, we still have properties under construction. We still have units being delivered to the marketplace, and now rents are starting to decrease. This is what we're seeing right now all over the Sun Belt and all across the country. The demand is not keeping up with supply, not because of job growth, but because of affordability. And I've been telling everybody for 9 months this was going to happen, and now it's happening. As we get down back below the long-term occupancy average, and we're not there, we're sitting somewhere about right here right now in phase 3 in most markets. As we get below the long-term occupancy average, this starts to go fairly fast depending on the recession. In most recessions, it happens pretty quickly. If this ends up being a really bad recession because of all the stuff that's going on in the market right now, it could last longer. But most markets, most indications are this can happen fairly quickly, anywhere from 6 months to 18 months, and you get out of it and you start to come back up again. That uptrend happens really slow. The downtrend happens fairly quickly. Okay. So that's the market cycle chart itself. So here's Dr. Muller, the second quarter 2022. So he lags in data and he only has the top 53 markets in the country. So in second quarter 2022, he had 2/3 of the market at equilibrium, and he's got 1/3 of the markets in hypersupply on their way to recession. Okay. If it's got a +1, it means he moved it forward 1 point. So that means Palm Beach and Phoenix were at 0.12 in first quarter. Now they're at 0.13 in third quarter. All right. If you see a -1, let's see if we have any negative ones. All right. Jacksonville, Houston, they have -1. That means they were at 12 last quarter and he's moved them back to equilibrium this quarter. So that's what those mean. Is there a question? Please mute yourself if you don't have a question. Whoops. All right, we got everybody muted. So here's just a fun chart. Some of you have seen me talk about this before. This is the stock market, but I like to correlate this to the real estate market and what's going on right now. So let's say we're coming out of the Great Recession. Everybody's in disbelief. No, I'm not going to put my money in this rally. It's a sucker rally, just like everything else. And then as it starts to climb, there's some hope. Oh, a recovery is possible. Flattens out a little bit and then it starts to go back up. Now optimism kicks in. Woo, this might actually be real. Now we're not putting any money in yet. Hey, we're suckers down here. Right now, Warren Buffett, he's putting in money down here, but we don't put money in down here. We wait. So then we get up to belief. Excuse me. Time to get fully invested. So now we're pushing our way through. Now we're putting our money in the market. Okay. We should have been putting it in down here, but you know what? We can get it here and we can still make a lot of money. And then we take that thrill ride. We get that real big skyrocket all the way up to here and we're just riding it and we're in euphoria and we're like, woo, yeah, let's go, baby. And then boom, it starts to go down. It's like, oh, well, you know, we're expecting a correction. It's going to come back. And sure enough, it starts to come back. So now complacency sets in. It's like, all right, we got this volatile market. It's no big deal. This is going to ride. It's just going to continue to go up. It's been trending up. It's just going to keep going. We're in a bull market no matter what we do. Okay. Kind of like what's going on in the stock market right now. Went down, what, 1,000, 1,500 points 3-4 weeks ago. It's come back up 600, 700, 800 points since. Kind of that complacency level, right? Well, then it takes this really big dip and now anxiety sets in. It's going to come back. You know, I'm getting some margin calls. Dip's taking longer than expected, but we're still okay. And then gets that really big dip and boop, it ticks up a little bit. And it's like, oh, I'm in denial. Now my investments are with great companies on blue chip stocks. You know, my multifamily investments are really good, strong markets. This is going to come back. I'm going to be okay. And then bam, the bottom falls out. Panic sets in. Oh, crap. Everyone's selling. Now I need to get out. And then so we sell here. We bought here. We sold here. Now, I don't know about you, but in most markets, when you buy low and you sell high, you make money. When you buy high and you sell low, you don't make money. So now capitulation sets in. Screw it. I'm 100% out of the market. I can't afford to lose anymore. I'm done. Now we get pissed off and we start to watch it as it just kind of trucks along, not really doing anything. Depression sets in. Your dog dies. Your spouse leaves you. You wreck your truck. And then, it starts to tick back up again. And we're right back into disbelief. And that suckers rally right back here. So I like to, it's a little fun representation of what goes on in the stock market, but I like to correlate it to what's going on in multifamily right now. If we think about it right here, this was 2021. Really probably up until about March of 2022. And now we're sitting right here. There's a lot of people that are still complacent because they're riding high on euphoria and they're not paying attention, even though we're probably sitting about right here, right now. Okay. So pay attention to this, because this is very, very important as we start to go down, as these interest rates tick up, as inflation continues to rise. This is just going to keep getting worse and worse until you get into denial, panic, properties go back to the lenders, people go into bankruptcy. Hopefully investors don't go to the feds, because then people start to go to jail. So let's not be complacent. You've enjoyed your euphoria. Time to start paying attention to what's going on. Okay, let's get the technology working again. There we go. So phase one, known as the transition phase. So now let's define these markets. Okay. Phase one is your period of reinvention. All right. So now we have to look towards a new business model coming out of 08. What was the business model? We had all these foreclosures, all these properties that had all this deferred maintenance. Everybody was looking at doing big repositions, big value adds. That was the business model. Buy it at foreclosure, sell it after you did the value add after 5 years of good, strong returns, and you got a great IRR and a great equity multiple coming out. Okay. We start to diversify our risk. So we can now, instead of just buying conventional multifamily, maybe we're buying self-storage, maybe we're buying low income apartments, maybe we're doing assisted living, things like that. We can start to diversify. We have renewed customer focus. So now, because we're repositioning these properties, our customers are our tenants, our residents. So we're focusing on them to give them better places to live. Lifestyle has become really, really, really important for the apartment renters of today. So we start to get that renewed customer focus. We know cash is king. It's really hard to get debt when you're in the recovery phase. So people that have been raising capital and collecting that cash, they tend to win in this market. You focus on fundamentals. Focus on fundamentals. This is underwriting, folks, not pro forma. Focus on fundamentals. And then, of course, consolidation accelerates for those that didn't quite fare very well in the recessionary phase. So what are our solutions in the recovery phase? Well, we start to build our pipeline. We start reaching out to those owners, those lenders, those appraisers, our influencers, and we start to build that pipeline to get some acquisition opportunities. We rebrand. If we've got properties we own, we start to rebrand those properties to get them better positioned for the coming market. We accelerate our value add acquisitions. We talked about that in the new business model. So we're going to accelerate those value add acquisitions. At a point during the transition phase, we're going to start to initiate development. We're not actually going to start construction until we get into the next phase, but we're going to start to initiate it knowing it's coming. We're going to expand our offerings. Okay, so capital that we're raising, acquisitions we're trying to get involved with. Maybe we're selling some non-core assets because they're ready to go. And then, of course, we're repositioning the assets that are in bad shape coming up through recovery. Okay, our next is the growth phase. This is expansion. Period of opportunity here is we've got rising occupancy levels, rising rents, growth in NOI, increase in asset value. There's development activity now happening. There's available capital and new competitors hit the market. Okay, we've seen this since about 2015, 2016. The new competitors, I call the student syndication world, which really exploded in 2016, 2017. That's your new competitors that were now coming into the market to compete with you. So what is our solution during the growth phase? Well, we expand vertically. If we're just doing multifamily market rent properties, conventional apartments, we expand vertically. Maybe we get into property management. Maybe we get into development. Maybe we get into some land banking, seeing that path of progress so that we can do future development. Okay, that's expanding vertically. We expand geographically. So if we're only in the Dallas, Texas market or in the Texas market, we start to expand out to Charlotte, to Orlando, to Nashville, Atlanta, and other markets that doesn't fit our core market, but the opportunities there for us to expand and be able to capture those opportunities. We expand our customer base. So now instead of just going after conventional renters, maybe we're going after low income, maybe we're going after senior. So we expand that customer base, invest in infrastructure, expand adjacencies. Adjacencies are those properties that are directly adjacent next to you. So if you can purchase land or buildings that are adjacent to you, then you can expand right adjacent to the properties you already own. And of course, you want to leverage your capital as much as possible at this point for better returns. We are coming out of this period. We are not in this period any longer. Do not make the mistake of believing we are. Here is where we are. This is the plateau phase. Okay, we are in the oversupply of the market cycle at this point. So what does this mean? Time to make decisions. Okay, we have a supply-demand imbalance, but it's not because of jobs. It's because of affordability, and that imbalance is occurring. That article from CoStar is a perfect example of that. Tenants, renters, occupants, residents, they just can't afford these rent increases anymore. So now they're moving in together. They're moving back in with mom and dad. They're moving in with family members, just like I said they were going to do coming out of the first or second inflation increase as interest rates started to tick up. We've got very optimistic underwriting going on. You guys are all seeing this. The underwriting has been stupid for 5 years. It hasn't stopped. Now is the time to go back to fundamentals in your underwriting. We have unrealistic asset values. Really? No way. Okay. Highest values in the history of our country, lowest cap rates we've ever seen. Okay. Unrealistic asset values, generous TIs. Okay. TI is tenant improvement. If you're doing a value add, rehabbing a unit, changing the landscape, changing the facade, redoing parking lots, these are all considered tenant improvements inside the multifamily world. Rent concessions are starting to happen, and there is a lot of high investment activity still going on, and we're seeing that, although we're seeing it slow big time. It is slowing down. We are at the point of getting ready to enter the recession phase, coming very, very soon to a theater near you. So what do we do in this phase? This is what I want you to pay attention to. If you don't pay attention to anything else in this presentation, this is the most important thing to pay attention to right now. Dispose of your non-core assets. Remember, when we were in the Texas market during our expansion phase, we went and expanded into other markets. Those weren't our core markets, but we were able to pick up some opportunities. Now you need to start disposing of those non-core assets. Go back to your core focus, because what's coming is going to be a rough ride, and you only want to be able to work on what you can focus on, not those other markets. Here's the most important one, and I'm still seeing this, and it's driving me nuts, although it is slowing down now. You must lock in long-term debt. I did not put this here. These are not my solutions. Okay. This is from the CCIM Institute. These are fundamentals. These are the definitions that were defined back in the 1970s. I didn't define these. I'm just teaching you what they are. I've been preaching them, but I didn't define them. So when you hear me talk about do not get short-term debt right now, do not get bridge debt, you must lock in long-term debt. I'm not telling you that because I'm a genius. I'm not telling you that because I'm psychic. I'm telling you that because that's the fundamental principle of the market we are in today. I can't emphasize that enough, guys and gals, but I'm still seeing people buy with bridge debt. That's crazy. Fundamentals. Sorry, I get on my soapbox sometimes. Build third-party work. If you're a real estate broker, if you're a wholesaler, if you are a bird dog or a strategic partner, and you rely on a transaction to pay you. So you do all this work for months and months and months, hoping to get paid when the transaction consummates. Okay. We're probably 15 minutes, 20 minutes away from Q&A, Misi. Third-party work would be consulting, coaching, education, mentoring, whatever you can do that will help you get cash flow during a period where there's going to be very few transactions. So as we leave the plateau phase and go into the recession phase, then, or the crisis phase, then you need to start having that third-party work. Don't wait till you get into the third-party, don't wait till you get into the crisis phase to start doing that third-party work. You need to start building that pipeline now so that the cash flow is coming in so you can make it through that recessionary cycle. That is so important for brokers. I cannot overemphasize how important that is. Okay. Start accumulating cash. I know that doesn't make any sense. Okay, Wade, appreciate it. You'll get the replay tomorrow. Accumulate cash. I know it doesn't make sense because we're in an inflationary environment. That doesn't mean you have to hold the cash. There are vehicles you can put it in. You can put it in a money market fund. You can put it in a CD. You probably want it in something you can get out quickly. The Fed just introduced a 12-month I bond where you can put your money in, and I think you can get like a 3.96% rate on it or something like that. I don't remember the exact number, or 6.39. I might have my numbers backwards. It was a little higher. So I think it's like 6 point something. You can get an interest rate on it, but you got to leave it in there for 12 months. So it's not that liquid. It's liquid after 12 months, but that first 12 months, in order to get that 6.39 on it, you got to leave it there. So there's a little bit of risk in that, but there are ways to accumulate cash. And then, of course, you need to downsize your non-core markets. Okay, get rid of those non-core assets. All right, crisis phase, where we're headed. Okay, this is a period of change. Rents are declining. We're already seeing it. There's a little development going on. The development that's happening now, it's going to slow. It's eventually going to come to a stop. A lot of them are going to deliver. Some of them are going to go bankrupt. We got little or limited access to credit. During this phase, lenders just stop lending money. They're already stopping on construction projects. It's really hard to get financing today. You've got to be a good borrower in a good market with a good property in order to get lending today. You need to start deleveraging. That's selling those assets that are out of your non-core assets. If you're over leveraged on a property, you need to dispose of it as quickly as possible. We have declining asset values going on at this time. For agency, you get workouts and restructuring. If you're in bridge at this point, you're toast. Bridge is not going to do a workout with you. They're not going to restructure with you. They're going to call your loan due. And if you can't pay it, they're going to take the property, period. That's why I'm telling you, you got to be locked into long-term debt. You've got to make it through this. Over leverage, Sean, is your debt coverage ratio, your DSCR, debt service coverage ratio. It needs to be able to stay within that 1.0 to 1.2 range, 1.25, 1.3. It's probably going to drop below the minimum during the recessionary phase. Some lenders will be idiots and call the loans due because they can, because you drop below your minimum DSCR. I don't think a lot will. They did that in 2008. I don't think they're going to do it again to a great extent. But if you're over leveraged, when your NOI drops, you actually will be negative cash flow and you will not be able to pay your mortgage, which is why you need to restructure or sell that property. What do you consider long-term debt? So permanent debt, 30-year Freddie loan. That is, it's got a 10-year prepayment penalty. Most life companies, which life companies still loan if you are a good borrower and they have a relationship with you, they will still loan during a recession phase. They are long-term permanent solutions. They also have prepayment penalties. So anything from 5 to 10 years could be considered long-term. You're going to have balloons on some of this stuff. You don't want anything under 5 years. If you can get it 7, 10 years, even better. So that would be long-term solutions. Yep, roger that, John. Good seeing you, bud. Okay. So what is our solution here? Well, believe it or not, we're going to start acquiring underperforming assets. This is when the opportunity kicks in. Okay. Remember, the best time to buy is just before the bottom of the market. So in the recession phase, we're entering that bottom of the market. We need to start acquiring underperforming assets, foreclosures, things like that. We need to acquire necessity real estate. So these are our core assets. And we can start to acquire market share, customer base, and talent because we're in first. All right. We made it first. When we're in first, we start to get that market share, build our customer base, and we can start to hire good talent because they are going to be looking for jobs. Right. So those are the 4 phases. Pay very close attention to that plateau phase. I would even say when you guys receive these slides tomorrow in PDF, you memorize that plateau phase. All right. So what do we got to do? Well, we got to go back to the basics. Back to underwriting fundamentals. You cannot buy on pro forma today. The outputs of your market analysis become the inputs of your financial analysis. If you are not doing a market analysis before you're underwriting, you are failing day one. You must do a market analysis so you understand what assumptions you're putting into the model. It doesn't matter what model you use. I don't care if it's Kevels. I don't care if it's Keynes. I don't care if it's Blancs or Sumrocks or Lindahl's, any of them. They all suck. Doesn't matter. What you put into it matters. That's where you get good information or not. If you put crap in, you're going to get crap out. Put good information in, as long as the model works, you'll get good information out that will allow you better decision making. Okay. Outputs of your market analysis become the inputs of your financial analysis. So here are the basics. First and foremost, you can still purchase today. The key is it must be cash flowing. Day one, debt service coverage ratio is greater than the lender minimum day one. You cannot buy on speculation. You cannot buy on appreciation. You must buy cash flowing day one in the plateau phase. Debt must be permanent. We covered this. Going in cap rate must be above the interest rate. We covered this. Otherwise, you are negative leverage. This cannot be an appreciation play. That's what these guys have been paying for the last 3 or 4 years. They have been buying on pro forma. When you buy on pro forma, you're buying appreciation. That's it. You've given the seller the money for you to do all the work up to that point. Okay, that's what you wanted to do. If that's what your risk allows, great. Stop it. You cannot survive if you continue to do that. You must buy on fundamentals. It must cash flow day one. You cannot buy on an appreciation play right now. Vacancy's ticking up, rents are going down. Okay, an appreciation play will not work today. All right, so let's look at our assumptions. First, we got to look at projected rents. Don't just look at 2021. Don't just look at first quarter 2022. If you get CoStar, and there are people that have CoStar, get a broker to get you the 20-year data summary report of all the rents for that trade area, for that market, whatever you're looking at. It'll go back 20 years. You can go back quarterly, you can go back annually. Look at the last 20 years and see what those average rents are. I guarantee you it does not average 21% rent growth. I promise you that. It's not even going to average 8%. They typically will average somewhere around 2 to 4, 4.5%, 5%. Pretty typical in most markets. There are some markets that are worse. There are a few markets that are better. Okay. If we look at the median is half or below and half or above. All right. But you've got to pay attention to those projected rents and not go crazy with them. We got to know what they are. We have to put them in the model, but we're not going to buy based on those projected rents. We got to look at our vacancy. Go back to that long-term average. Vacancy is now ticking up. because supply is continuing to hit the market. They're hitting the market at these high prices. The renters can't afford it, so they're not absorbing. When they don't absorb, vacancy increases, rents start to drop so that they can fill those units. When the A's, because they're delivering A's, start to drop, it puts pressure on the B's. When the B's start to drop, it puts pressure on the C's, and it just keeps going all the way down. Roger that, Greg. See you, bud. Income growth. Do not. Well, you know what? I don't care what you put for income growth. Here's the key. When you look at income growth and you look at expense growth, this is a way to manipulate your financial model. I can put 5% income growth across the board for 5 years, and I can put 2% expense growth across the board for 5 years. What do you think my NOI line is going to do? Well, it's going to do this. It's going to go up and to the right, right? That's manipulating your model. So here's what I tell everybody to do. Income growth and expense growth. I don't care if you put 30% income growth, 30% expense growth. Make them equal. Make them equal. You will not manipulate the model if you make them equal. You have no idea what income growth is going to be next year. You have no idea what expense growth is going to be next year, let alone 3 or 4 years from now. Just make them equal. Let the property perform the way the property is going to perform. Do not manipulate the model. That is good fundamental underwriting procedures. Look at your refi assumptions or that exit cap rate, whichever the case is. There were a lot of people that purchased in 2019, 2018 with a 3.5, 3.25 interest rate, thinking in 2022, 2023, they were going to be able to refi out or sell at a 4.5 cap. Guess what? Not happening. Not even remotely close right now to happening. So what's going to happen to all that short-term debt when they assumed they were going to be able to refi or sell at a 4.5%? What do you think is going to happen to them? You think the lender is going to give them an option to go another year or two? Interest rates have doubled. Why would they? They'd be crazy to allow that extension to occur when they can take that same money and make double the income on it. They don't care about you. They don't care about your tenants. They care about their shareholders, and that's all they care about. All right. So pay attention to that exit cap rate and pay attention to what's going on with interest rates and what's going on with inflation so that you can properly predict, and it is a prediction, what that exit cap rate is going to be. Operating expense ratio is a test that you can use to ensure that your underwriting fundamentals are good. All right. So what I like to do in year one, if my operating or at your stabilized, so if you're doing a value add, say year 3 is stabilized. At year 3, my operating expense ratio is, 35% on a 1970s product. I don't care how much lipstick you put on the pig, it's still a 1970s product. The minimum operating expense ratio you're going to get is going to be about 45%, maybe down to 43, depending on the rents. Now, the exceptions there are going to be New York City, San Francisco, Los Angeles, Miami, places like that where your rents are just ridiculous. When your rents are outliers, then your operating expense ratios are going to be lower. Oops, somebody's Misi. I'm going to mute you, Misi, unless you had a question.
Yes, sorry, I went away to take a call, but yes, I do have some questions. I always enjoy economic session, and
some questions. We're almost done. Can you wait till the end for some questions, or do you have a pressing question right now?
Oh, sorry. I thought it was Q&A because it just.
Oh, no, we're not.
Go ahead.
Okay, thank you. So your operating expense ratio is a test for your underwriting. So the way we look at that is if it's newly built, the minimum that Greystar, which is the #1 property management company, it's okay, Missy. It's the #1, they are the #1 property management company and own more units than any other company by more than double. Actually, I think it's by more than triple than the closest competitor to them. Greystar on a Class A building in most markets can only operate at 35%. Do you think you, being in this market for the last 3 or 4 years, are going to be able to operate a 1970s product at below 35%? I'm here to tell you it's not happening. Okay. So your operating expense ratio is a good test to see if your underwriting is good and sound. Older properties should be somewhere between 45 and 55%. depending on the rents, depending on the utilities, who pays what, the expenses in the market, things like that. But it's typically around 45 to 55%. In 2018, I did a survey of all the T12s that I was getting around the Southeast within Louisiana, Mississippi, Tennessee, Alabama, Georgia, and Northwest Florida. And I found an average of properties over 100 units, so ones that have payroll, in-place management, on-site management, they were around 48%. It was like 47.7% on average, all those properties. Now, the rents have gone up quite a bit since then, but so have the expenses. Okay, so this is a great benchmark. Again, high rent markets will not apply. Okay, San Francisco, New York, Miami, Los Angeles, San Jose, Santa Clara area, they will not apply. Smaller properties will not apply because there are less expenses on smaller properties. So if you've got like a 10 unit, 8 unit, 6 unit, you cannot use this operating expense ratio. That's not going to apply, right? So the other test is if I take my underwriting to the lender and the lender is willing to give me a 70% loan to 75% loan to value, and it's agency, they're willing to give me 75% loan to value. The reason they're willing to do that is because my debt service coverage ratio is greater than their minimum in year one. I'm cash flowing year one, equal to or greater than their minimum debt service coverage ratio. And I've seen it between 1.2 and 1.4, anywhere in between there, depending on you, depending on the market, depending on the property. One time I saw it at 1.15, and that was a Blackstone purchase, but that's the only time I've ever seen it below 1.2. So this is a great test to know if your underwriting was solid. Now, I hear all the time people say, Fannie, Freddie, they're only offering 55% because of market conditions. No, that's crap. It's because you're overpaying for the asset. It's because your debt service coverage ratio does not meet the minimum in year one. That's why you're only getting 55% loan to value. They'll gladly loan you 75% if your debt service coverage ratio meets it year one. Okay, another great test. So what the lender is going to do is they're going to give you the minimum of loan to value or debt service coverage ratio, whichever is lower. Okay, so that's why you're getting a 55% LTV, because that 55% LTV gets you a 1.25 debt service coverage ratio. At 1.75, it might only be 0.78 debt service coverage ratio. They're not going to loan to you. All right. So those are the basics. So now what? Well, we need to dispose of our non-core assets, just like it tells us to do in the plateau phase. We only purchase cash flowing assets. We get out of short-term debt today. Guys, gals, if you're in short-term debt right now, get out. If we go into that recessionary phase, it's going to be too late. That lender is going to take that property back. They are not going to give you the opportunity to fix it. Get out. Even if your business plan hasn't been met yet, get out of that short-term debt. You need to create 3 third-party opportunities. This is especially important for brokers and those that rely on transactions. So you need to work towards consulting, coaching, and training. You being that consultant, you being that coach, you being that trainer. And now is the best time to build relationships. I talk about relationships all the time. And now is the best time to educate yourself. So what is good education? Well, most courses give you the what you need to do, the why you need to do it, but they never teach you the how. Have you guys ever noticed that? You never, ever get the how to. It's all about the high level. Even when you pay thousands and thousands of dollars for these courses, you never get the how to, exactly how that mentor or that educator did what they did. They just tell you this is what you need to do. They don't tell you how to do it. Well, introducing the Strategic Partnering Workshop. This is a 14-module how-to course that leads you from acquisition all the way to exiting the deal. So Misi, who is here, welcome Misi. I'm going to talk about you for a minute if you don't mind. Misi was looking to get into multifamily for a while, but struggled to find guidance on proper underwriting and how she could leverage her W-2 skill set to work for her in multifamily. She works for Walmart corporate. She'll have to come on and tell us if she got her position for site selection or not. I know she was working towards that. She was frustrated with other communities she previously joined because it was more about the flash and hype versus no nonsense practical steps she could follow to achieve her goals. After Misi joined strategic partnering, she implemented our steps and figured out how to leverage her W-2 knowledge. Today, Misi not only filled her pipeline with multiple deal opportunities, but she's completed a couple of successful capital raises now, and she's got active positions in her multifamily deal. So congrats, Misi. You've been amazing.
Thank you, David. Well,
Yes, ma'am.
Support and guidance.
Absolutely. Did you get, just real quick, did you get that site selection job?
No, I think it's too much work.
Yeah, no worries. I'll agree with that. I teach those guys W-2 with Walmart. So yeah, or 102 for market analysis. All right, so moving on. So you're going to get access to the 14 module strategic partnering workshop where you're going to learn beginning with the end in mind. Guys, this is literally A to Z. We start with, what are your goals? What are you wanting to do? Why are you wanting to be in this business? This is a lot of work. Okay, so how are you going to move forward here? We begin with the end in mind in module 1. Then we go into strategic partnering. We identify what role you're going to play within multifamily. Nobody can do everything. There are so many different roles involved. You've got capital raising, acquisitions, due diligence, asset manager, underwriter, all these different positions within a syndication or within an acquisition that you can't do all of it. You're going to have to partner. This is a relationship business. So you need to identify what role you're going to play. And I show you exactly how to do that in module 2. Module 3 is all about building relationships with investors, building relationships with JV partners, other syndicators, co-sponsors, vendors, attorneys, CPAs, appraisers, bankers. And yeah, I talk about brokers, but I don't put a lot into brokers because honestly, they're going to hurt you more than they help you until we get into the recession phase. When we get into the recession phase, you're going to need the brokers. Okay. Module 4, we underwrite the market. In part 1, we talk about market cycles, which we just did a great class on market cycles, and key performance indicators, those assumptions that we need in order to put into our underwriting. Then we go into current economic base. Current economic base is where we actually determine what current demand is today. And then we go into future economic base where I give you a crystal ball and you can literally predict what the future population is going to be for any market in this country. I show you exactly how to do it, provide you the resources or where to get the resources for free. And that allows you to do a future demand supply analysis from 12 to 24 months into the future. Most powerful part of the entire course, hardest part of the entire course, most important part of the entire course. But I'm biased because it's what I teach for the CCIM Institute. Okay. In module 5, we talk about finding off-market opportunities. This doesn't have anything to do with brokers. This is all about direct to owner. I actually give you the marketing plan I used to find $560 million in off-market deals in 2018. I give you the automated email sequence that I used to find that same amount of inventory. I give them to you, hand them to you. Here you go. Here are the plans. You just need to modify it for you and implement it and how to reach out to those owners. Module 6, now we got to underwrite the deal. We found a market. We found an opportunity. Now we have to underwrite the deal. So after we underwrite the market, now we underwrite the deal. In part 1, nobody ever talks about all the acronyms and definitions. What is NPV? What is IRR? What is discount rate? I go into all those acronyms and definitions and break it down by what we call the APOD, the annual property operating data, from that potential rental income, PRI, another acronym, potential rental income, all the way down to cash flow after tax, not just before tax, but after tax. Then we go into needs, exit strategy, KPIs, and fees. How do we get paid? Okay. After that, we go into verifying assumptions. So we went and got our assumptions in market analysis. Now we bring them into the financial analysis, and we got to go verify all those assumptions. And then in part 4, we take everything that we've got, we put it in the financial model so that we can come up with a go, no go decision. Okay, now that we've got an opportunity, we've underwrote it. Now we have to negotiate and get towards an LOI. So I teach you the CCIM way of negotiating, where we use a negotiation chart, which is a stakeholder issues chart, where your stakeholders are across the top and your issues across the side. We identify every stakeholder and what the issues are so that we can come to some kind of an agreement, a win-win agreement. And then we submit an LOI, and I go over the LOI, give you an LOI template and what clauses you're looking for on that LOI. Now that we're under contract on a property, we got to start due diligence. In 102 for CCIM, we teach what's called the strategic analysis model. Look at it as a stool. So the strategic analysis model is due diligence. And think about this, and you'll see what I mean. So the seat of the stool, that is our decision criteria. Those are our alternatives, so that we can create goals and objectives and come up with a go, no go decision. Well, how do we do that? Well, there's 4 legs that support this stool. Miss any one of those legs and the stool will tip over. So those 4 legs are market and competitive analysis, module 4, political and legal analysis, location and site analysis, that physical inspection. Political and legal would be, is the market landlord friendly? Is there any violations on the property? Does it meet zoning? Things like that. And the last leg is financial analysis. The market analysis leg, the outputs become the inputs for the financial analysis. Miss any one of those 4 legs, your stool falls over, you miss something in due diligence. Okay, so I teach that in depth in module 8. Module 9, we actually finally start talking about syndication. There's no need to talk about syndication up to this point. Right now, all we did was build relationships. We picked a market. We found an opportunity. We underwrote the opportunity. We submitted an LOI. We've done our due diligence. Now it's time to raise capital, if we need to raise capital, depending on the size it is. Maybe we do a JV. Maybe we buy it ourselves. We don't need to raise capital. If we're raising capital, module 9 covers it all. We start off with understanding syndications, those legal aspects of it, how to put a deal together in a syndication, how to create the LLCs, things like that. Part 2, we talk about the offering summary. I even brought in Gene Trowbridge in March, and Gene did a syndication structure, laws, and regulations for syndication to keep you out of jail. We can teach you all day long how to go to jail. Nobody ever teaches you how to stay out. So Gene came in and did a great supplement on that, and that's part of the course. Excuse me. In module 10, I cover getting a loan. Somebody most of you know near and dear to your heart, Julianne Peterson. She came in and did a supplement on how to get a Fannie Freddie loan in the market in 2021. I think she came in somewhere around June or July of 21. So that was accurate for that time. It's going to be a little different now because the market has shifted. Interest rates have gone up. Module 11 is all about property management. I used to own a property management company. I may know what I'm talking about a little bit when it comes to property management. So the first thing we talk about is understanding operations. The most important part of operating that property has to do with maintenance. And even more importantly, has to do with preventative maintenance. So I actually explained to you exactly how to create a preventative maintenance plan, which lowers your operating costs. And of course, we go into leasing strategies and management responsibilities and everything else under understanding operations. But the most important part of it is preventative maintenance procedures and creating a preventative maintenance plan. Then in part 2, we deal with the property management questionnaire. How do we hire a management company? Is that management company on-site or are they off-site? 49 questions I've listed. You get the questionnaire as well as talking about every single question on that questionnaire. Well, we got a question here. Let's see. Awesome. Okay. Module 12, now that we've got our capital, we've closed on our loan, or we've got a term sheet, and we've hired our property management company, so we've got our operating partner. Now it's time to close this deal. So in module 12, I go over all the documents you need, give you the checklist for pre-closing, during closing, and post-closing, which includes management turnover, utility turnover, proration of rents, your tenant deposits, and all the different documents that you need when you go into a closing situation, whether you're there, whether it's remote, we talk about it all. Now that we own the property, now the hard part starts. From module 1 to module 12, that was the easy stuff. For asset managers, you know what I'm talking about. For those of you that want to be asset managers, when you see module 13, maybe you think again. Asset management is the hardest position of this entire process. You're responsible for the asset after closing. It's your deal. If it gets screwed up, it's on you. You're responsible for communication, 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 communication. That's right, Sean, it will. You got to communicate with the sponsors. You got to communicate with the CPAs. You got to communicate with the attorneys. You got to communicate with property management. You got to communicate with the investors. And if you're doing a value add, you got to communicate with the project manager. And you got to make sure the project manager and the property manager are communicating together. And you have to determine how often you're going to meet, for how long, and what you're going to discuss. And you're responsible for everything during operations. So whether that's 1 year, 2 years, 5 years, 10 years, it's on you. You have a team, but it's your responsibility. So we go into great detail on that, and it is all about communications. Finally, our business plan is complete. Now we can exit this deal. And so now we talk about exiting the opportunity. Now we rely on brokers. Do not try to sell this property yourself. Brokers will get you the best price in the least amount of time for what you're trying to do. I promise you, okay? I talk about staying away from the global brokerages in hot markets. Now you're going to hire the global brokerage to do this for you because they will do the best job. So we go over, once you exit, what do you do with the funds, doing the property management turnover, the key turnover, all the tenant files, who opens the bank accounts, who's on the bank accounts, all that stuff once we, that was closing the deal for bank accounts, but exit strategy, same thing, only the other direction. So there's homework between each session to keep you moving forward. The course is set up to deliver a session every 3 days, so you have time to do the homework and move forward when you're ready. Initially, I wanted to do it every 7 days. It's kind of a big gap. Some people complain, so I shrunk it to 3 days. Seems to be a good happy medium. This eliminates overwhelm and gives you structure on where to start. We help you build your systems so you don't have to do it on your own. You'll see that all the resource, every single section has resources, every module. You are building your system. How to acquire, how to build relationships, how to do due diligence, how to close on a deal, how to asset manage, how to raise capital. You're building a system. So we help you build that system through this course and with the resources. So in addition to that, we also are going to give you the multifamily underwriting case study. Okay, this shows you a real world example of how I find a market, find a deal, underwrite the deal, and submit an offer. And we do that in the case study. Module 1, we actually went out, the students and I, and we identified a market. This is a recording version of live sessions that I did. Once we identified the market, we had to build relationships with broker and owners in the market. From there, we had to identify our assumptions. So we had to do a market analysis in order to determine those assumptions. And then we underwrote the deal. And once we underwrote the deal and got to that go, no-go decision, we decided whether we were going to submit an LOI or not. Now, we put an LOI together either way. That way you could see the process getting done. But I'll have to tell you that in both situations, when we did the underwriting case study, neither time did the numbers make sense. We did not actually submit the LOI. On the first one, it was a fictitious one anyway. On the second one, it was an actual live opportunity in Frisco, Texas. Sean, I think you remember that one. We talked about that. So at this point, you have all the training and resources you need to find and win deals. So here's Trevor. Trevor's number one issue before strategic partnering was deal with overanalyzing things, which led him to search for a program with structure. He previously joined a bunch of groups in multifamily, but felt they lacked guidance on how to provide value in a multifamily transaction, being relatively new. He found success implementing our process to help build his brand awareness and presence. With our straight to the point approach, he learned to double down on his strengths and found his strategic partnering role of asset management. The man loves asset management. After following the process and getting rid of his limiting beliefs, Trevor found his way to provide value in deals and now has his dream investors worth millions in net worth calling and asking to partner with him. Trevor has become internet famous. I literally got him out of his shell and he seriously has become internet famous. The guy is doing amazing. As a bonus, you're going to get access to the private strategic partnering community for free for the next 3 months. In the strategic partnering community, you get to build relationships with other syndicators, other co-sponsors, other passive investors, other vendors, brokers. We have all kinds in our community, from people that have started from very beginning to people that have done multiple deals like Sean Griffith that's on this call. You get to ask questions for help, list opportunities, and get support for underwriting. This is a private community, has its own private channel, and it's not Facebook or Slack. It's actually on a channel called Mighty Networks. Belonging to a community will give you the power to build the relationships you need to close deals. When you add a community to the education and resources, you have a very powerful combination of tools at your disposal. And if that's not enough, you'll have the ability to request CoStar and Site to Do Business reports for calculating demand and supply and underwriting your deals. So I have National CoStar and I have Site to Do Business through CCIM. There is a form in the community that you can fill out, and we'll teach you how to do it inside Module 4, as well as a video inside the community. All you have to do is fill that form out, submit it to me. I will pull the data for you so that you can do the market analysis and get those assumptions for your underwriting. I'm going to help you underwrite your deals, and I do that by determining those assumptions. I won't actually tell you whether it's a good deal or not. That's on you, but I will tell you if your assumptions are good or not. I help you pull the demand supply data, connect you to JV partners, connect you to sponsors, connect you to key principals, and find passive investors. Every Monday in the community, we have a live virtual goal setting workshop via Zoom. Every Thursday, we have a live virtual weekly Q&A and networking via Zoom. Every month, there's a new mindset training. We actually just started these next 3 this month. The first mindset training is already in the members area, so that you can become the person capable of being successful. If you don't have the right mindset, you're never going to be able to fully succeed. Every month, there's a new marketing training, so you're always up to date with the latest marketing trends and tactics. That first monthly marketing will get into the members area next week. Every month, there's a masterclass on the latest trends in multifamily and the economy. Guess what? This recording is going to be the first masterclass for the monthly masterclass. And then in 2 weeks, when I do the underwriting masterclass, that one's going to go in there. And then 2 more weeks, when I do the next one, that will go in there. We now have combined mentoring with all the education, all the resources, the community, and added accountability so you can't fail. But why stop there? I'm going to give you support anytime you need it. You're going to get personal support via social media, direct message through either LinkedIn or Facebook, through email, and through Voxer. You can ask Misi and some other folks that are on here. I like Voxer. Voxer is a great tool. You can do voice messaging through Voxer, and it's immediate. It's direct, kind of like texting with voice, and it's a good tool. Good chance, especially when I email you, you're going to get my cell phone number. I don't hide it. You can text me. Personal support is personal support, okay? There are many communities charging over 25 grand a year for only half of what we have in strategic partnering. But I wanted to break down the barrier of entry into an education and mentoring community like this. So right now, for the participants of this masterclass, I'm offering access to the strategic partnering workshop. You get that for life, as well as the underwriting case study and the community and mentoring for the next 3 months for only $997. There's an unconditional, no questions asked 30-day money-back guarantee, so there's literally zero risk. And this offer is only good for the next 5 days. As a bonus, You get to bring your business partner or spouse for free. But wait, there's more. For the first time, and I've never done this before, as a fast action bonus, meaning if you purchase tonight, it's got to be tonight or this goes away. If you purchase now, which is tonight, I'll give you an additional 3 free months to the strategic partnering and mentoring group. That's a total of 6 months for free. So Yvonne, when he came to strategic partnering, he was overwhelmed with all the misinformation being told by the gurus. He was working harder than needed and running out of time to make something happen. We help Yvonne stop doing all the other stuff and focus on just the fundamentals. We kept him accountable in order to start getting results for himself. Yvonne, within the first year, gained the confidence to help close a $12.3 million deal and got a fund manager position, and he's crushing it at age 22. So let's recap. Strategic Partnering Workshop, that is a $1,997 value. After Sunday, it goes back to $1,997. Okay. This $997 value is only for the next 5 days. The multifamily underwriting case study has a very conservative $997 value. The strategic partnering community with all the resources, all the live mentoring, the Q&As, the accountability, the people inside the network, very, very conservative $9,997 value. The personal mentoring and support, which is my time, very conservative $9,997 value. Weekly Q&A, goal setting, mindset, and marketing, very conservative $4,997 value. Business partner or spouse for free, that one's priceless. So that's $27,985 in real value for only $997. But don't forget the unconditional, no questions asked, 30-day money back guarantee if you're not satisfied, and you get to bring your partner or spouse for free. 2 for 1. Okay, it's a twofer, but only for the next 5 days. And if you act today, you'll be able to get an additional 3 months to the strategic partnering community and mentoring group for free. So that's a total of 6 months for free, plus the workshop, plus the case study for $997. So here's the link. I'm going to grab it and I'll throw it in the chat. If you guys are interested, we'd love to have you in. Let me put this in the chat. There it is. You will see a timer on it. It will expire by Sunday night. No, Kim, I don't need to take your money. You're good. You don't have to pay for anything. You get all this anyway. But nice try, though. For the people that buy today, once I get the notification that you've paid, I will go into your account and I will add an additional 3 months. So when you go to check out, it's going to tell you there's only 3 months for free. I will add another additional 3 months. There wasn't any way to do that, automating the process. So I guarantee you I'll be able to do that. Okay. I want to send the, that'll be fine, Todd. You can absolutely send you the recording. All right. So that's it. Q&A. Ooh, hour and 40 minutes. Sorry that took so long. Normally I try to keep the education to an hour so we can have 30 minutes of Q&A, but important stuff to talk about. So what do you guys got? Time for Q&A. Let me see if I can pull y'all up again so I can see you. Jason's got a question. So Jason, go ahead. You got it.
Yeah.
There you are.
So, yeah. Hi, David. Great presentation. So, I can personally say that you give a lot of value to your students. And I do everything that you will have taught in this presentation, except for working on third party whatever word you just use for that. And my question is, multifamily takes up so much time, you know, like finding deals, networking, underwriting. How would you fit that into your day without losing focus on multifamily?
You have to determine your priority. So you got to continue building your business, obviously. And so you prioritize what you need to do to build your business, knowing the situation we're in the market, and then prioritize how much time do you put towards that third party work or consulting, training, education, coaching, whatever you decide to do, and how much you put towards your existing business. So it's just a matter of scheduling all that, which you are on the goal setting workshop just about every Monday night. So that should be able to help out with that.
Okay, David, thank you.
Yes, sir. Great question, Jason. Thank you. Go ahead, Sean.
Hey, David. Yeah, thanks again for all the great info. Just wanted to ask a little more detail around looking at how do you slice and dice the data when you're comparing like world economy versus US economy versus state and local economy, because the different pockets are going to behave differently, right?
Correct.
I had one very respected multifamily person that he's got over $1 billion of assets under management. He made the comment, ain't going to be no recession in Frisco, Texas.
I would beg to differ.
Okay.
And again, it's going to be affordability.
You
I would
think
agree.
affordability is going to drive it no matter where you are.
Correct.
I'd have to say that I agree with you, because I'm seeing a pretty significant uptick in the number of tenants that are struggling to pay rent, and the number of evictions that we're having.
Correct.
And my property management company is struggling to deal with that. So we're starting to look at, holding down the rent, or, we're not doing any more rent increases. We're basically trying to keep things flat where we are.
Right. And you're lucky, because a lot of people are having to lower the rents. Yeah.
I think I know who you're talking about, Sean. And I wonder if they are going to, they're starting a new development project now. So I wonder if they're going to continue on that original timeline of that project, or will they slow it down?
You talking about revision masters?
Yes.
Knowing them, no.
I'm talking about that project in Sherman.
In Sherman, yeah. I doubt they're going to slow that down. I mean, because by the time they get that project built, it's going to take them a while. And by the time Apple and TI get their plants, started going up there, they're going to need workers, and the workers are going to need someplace to live. So I don't think it makes sense for them to slow it down.
Okay, I guess that makes sense.
Again, that's just I know next to nothing about development, even though I have a development project going on.
I don't know anything about their development, but I do know what happens when we go into a recessionary phase and development projects are going on. It depends on how capitalized they are, and if they have the cash to continue construction, because if they don't, it's the lenders that will put a halt to the project, not the developer. The
developers are well capitalized.
Yeah, they have to push through. They don't have a choice. They either push through or they fail. So they will not stop. You've got to continue to move. It's the lenders that put a halt on these projects.
Yeah, and we're probably going to slow roll our development project just because of that. But
so,
no, go ahead.
Sorry, Sean. And I apologize if there's a lot of background noise. I'm actually driving up to Canada right now, and that's why my camera's off. But I just want to, one point about, especially with it being $1 billion, a syndicator, they have a lot more to lose. So they're going to project that image just so they can keep their investors that everything's rosy and nothing's going on. So I think it's really important to kind of keep that in mind as well, because I know some of these $1 billion investors or syndicators, and they're all, or a lot of syndicators just projecting the same image that everything's great and the rents are still increasing and everything, versus what's going on the market. I think it's really important also to look at what's going on in Europe, because keep in mind, the US is going to help, you know, send out some of the resources to Europe and stuff, which is going to drive up prices in the US as well. So there's a lot going on globally that's going to impact the US and affordability and everything. And, you know, take a look at layoffs going on. Every single tech giant is announcing layoffs, and that's just going to go downhill from there, going into all the other sectors as well. So I think it's important to look at all the macroeconomics, you know,
Yeah,
And
factors that are going on.
it's not just them, Hamad. All the global brokerages are starting layoffs now as well.
yeah, I mean, that definitely agree with you there, Hamad. And, you know, and some of David's favorite gurus like Brad Sumrock and
My buddy.
and yeah, your buddy. You know, I mean, one thing I will say about Brad, his last meeting, he was talking about, you know, the changing environment and how you have to adapt and you've got to be, you know, more cautious. And, you know, he's not just out there, and I won't use the term we used in the military, David, but he's not out there trying to paint a rosy picture when there isn't a rosy picture. You know, he does try to point out, you know, yes, deals can still be done, because I mean, that's where he makes his money, right? Is getting people into his education program. But at the same time, he's not selling smoke and mirrors like some of those guys.
Right. And I've heard that, and that's good. So, Jeremy, to answer your question real quick, and then I'll let Kathy talk. Brad Sumrock is who Sean's talking about. We're not best of friends, if you will. And I take every opportunity to throw darts his way every once in a while, but I've been good at being calm about it lately. He's actually come around and he's not trying to talk people into buying when buying isn't the smart thing to do. So he's coming. I'm coming around a little bit with him.
Does he know how you feel about him?
I have no idea. Probably not. Unless Sean told him.
Well, you know, I haven't been on his jet with him yet, but the next time I am, I'll let him know.
Yeah, Roger.
I was curious, who you mentioned global brokerages are laying off.
Yep.
Who are the global brokerages?
Cushman and Wakefield, CBRE, Marcus and Millichap, JLL.
Okay, those.
ARE Newmark or Newmark Knight Frank. All your big global brokerages are all reducing expenses and starting to lay off non-key personnel.
Wow. Okay.
Basically, if you're a junior broker and you haven't been performing, you're out.
Out.
Yeah.
Yep. Because a lot of those brokerages, the brokers, especially early on, they get salaries. They're not just commission based.
Okay.
Good questions.
I thought Missy had a lot of questions. Where is she?
She had to step away for a minute. She'll ask when she gets back.
Okay, well,
I'm sure we can fill in for her, Kathy.
Yeah,
I'll
there's
just
still
ask-
48 people on this call. We'll be here a little while.
just the question to clarify. You mentioned core markets versus non-core. I think did you say core markets, or were you talking about core assets? And can you define what those are?
So either or, it's where your focus is. So I'll use McKinley, who's one of my favorite owners and one of my favorite property management companies. They were originally based out of Detroit, Michigan. Actually, it wasn't Detroit, but it was in Michigan. And they moved to Orlando. They owned apartments all over the Southeast. And they came to a decision about 4 years ago to dispose of all their non-core assets and determined that their conventional apartments in the Orlando area, in the Orlando, Tampa MSA, was their core market. And they disposed of everything else, which were tens of thousands of units all over the Southeast and Michigan. And so that's
so you
what I
don't
mean.
you don't mean you know, tier 1 or tier 2 or tier 3.
No, I'm not
It's
talking about the type of market.
It's just what
I'm
you
talking
want to
about-
concentrate on.
Correct.
And what about core assets?
Same thing. So if your core asset is conventional apartments and you've got self-storage facilities You need to get rid of your non-core assets and only focus on your core assets.
Okay, I wondered if you meant by core assets like Class A properties that cash flow, no value add.
Nope.
type.
Well, you want cash flow, but that didn't have anything to do with whether it was a core asset or not. Core asset, core market just means it's your focus.
Okay.
Guys, and I didn't know what to do with that house. You are painting the picture for.
I muted it.
So David, would another way of saying your core properties, your core asset or your core market is that is your area of focus or expertise?
Yes.
Yeah, but
100%.
what if that area is, a tertiary market? I mean,
If that's your core market, so what?
Yeah,
and
I've got some great properties out in Tyler and Longview. That's
I
and
used to own a
really
property in Longview.
I'm really starting. Yeah, I know. I'm really starting to think about moving my core to the Tyler market for a whole
Tyler's a good
host of
market.
reasons.
Tyler's a good market.
okay, thanks for clarifying that.
So Cherie had a question in the chat. What's the best way to find off-market small apartments, seller finance deals? In my opinion, I cover that extensively in module 3 and module 5. You have to reach out to the owners yourself. You're not going to get it through a broker. Brokers will not deal with owner financing because they don't have any way to get paid unless you bring the cash and pay them. So they don't like it. Same with wholesaling. Brokers don't like to deal with wholesalers because they can't get paid. So you've got to go direct to seller. And module 3 and module 5 talks extensively about how to do just that. Really module 5 more than anything. That's where the marketing plan is. That's where the automated email sequences are and everything else for finding those off-market deals. And then you just have to negotiate with them once you find them. Really depends on through questioning, Cherie, asking them what's going on with them, what their issues are, problems. You'll be able to identify whether there's an opportunity there or not. It's just all about good questioning. All right, let's see. Anyone close to Tatum? Where is Tyler? So Tyler and Longview are in northeast Texas, right along I-20, in between Shreveport, Louisiana, and Dallas.
And it's about an hour and a half east of Dallas.
And about an hour west of Shreveport. Okay, good, Kathy. Okay, good. David, did I hear correctly? There is a class. Okay, so it's not a live class, Richard. The recordings will open up for you every 3 days. So module 1, as soon as you get in, module 1 will be open to you. In 3 days, module 2 will open. In another 3 days, module 3 will open, all the way through the 14 modules. So all the resources, all the sessions that are, you notice there were multiple modules, had multiple sessions. Those will all open in the single module. So you'll be able to get through the whole thing within 14, 14 times 3 is 42 days, 45 days, in less than 45 days. You're not going to be able to get through that whole course that fast anyway, just because of all the homework and everything you've got to do in between each session.
And it'll help keep your head from exploding.
Yeah. Thank you, Diane. It was good seeing you. There is no time limit. It's totally at your own pace. And guys, I am available. If you need a question or have a question, reach out to me. If I determine that it's not going to be able to get answered in an email or in a Voxer chat, I'll throw you a calendar link and schedule a call, and we'll do a 30-minute to an hour call. I can guarantee you when you get into market analysis, you will be scheduling a call with me. I promise. Everybody does.
At least
I'm
one.
absolutely okay with it. At least one, yeah. Maybe more. I'm absolutely okay with that. It is very, very important that you understand that market analysis part. Me. That's who you contact. You contact me. David at davidmonroeccim.com. You're going to get an email that's going to get you access to my Facebook, my LinkedIn, my Voxer, all of that. So once you sign up, you'll get access to all that. Won't be a big deal. We'll go get Terry. It was good seeing you. Awesome. I'm looking forward to getting started with you. Let's see. We still have 46 people here. I tried to stay on until we get under 10. I hope you guys don't keep me here all night.
Well, you got up to like 80 something, so I think you surpassed your goal.
Yeah, well, 86 was the highest I saw, but 471 registered. That's still a terrible show up rate. But at least it was more than 50. Thanks, Sonia. Good seeing you. Thanks, Cherie.
Hi, David.
Yes,
Can you hear me?
I can.
Yes, hi, this is Alex. I'm sorry,
Yeah.
I was having internet problems, so I logged in a little bit late. So I
No worries.
apologize if you already addressed this, but I'm looking at residential interest rates of like 7 to 7.5%.
Yep.
And with the way things are going, I don't know what the elections are going to bring today, but we might have
Good.
I hope that we'll have a change of leadership here soon, but your views on where the interest rates are going over the next, let's say, you know, into Q2 or Q3 of 23, and how that affects our ability for someone who's a newbie like me getting into this. How does this affect you putting a deal together, and, you know, being able to really make the thing pencil out, because that's the bottom line. It's got to pencil out before you can do anything.
Yep.
Thanks, sir.
Oh. See you later, Sean. Good having you.
No,
man.
I was just waving. I had a comment on that statement.
I'll let you go first then.
Okay, that whole process of, you know, who's in charge in Washington, quite honestly, doesn't really matter. What you need to know is what are the rules and how do I make money under those rules? And, you know, the interest rates, like David said earlier, you know, back in the, like, you know, 80s, you know, we had interest rates up around, you know, 12, 15, 18%. People were still buying property. Granted, it was cheaper then, so you could make money at those high interest rates. But it's all about knowing what the rules are today. You know, everybody can go out and predict, oh, it's gonna do this or it's gonna do that, depending on who gets elected or what phase the moon is. It doesn't matter. Whatever, you know, whatever's going to happen down the road, you have to go with what are the rules today, and you have to set up and be reasonably conservative and prudent in your planning going forward, so that you're not, you know, if somebody came in last year and bought a property and they were assuming that they're going to keep getting, you know, 15% interest bumps every year, they're in trouble right now, because they're not going to hit their business plan. You know, I look at CoStar, which is I consider to be, you know, reasonably accurate on things. They're predicting a 10% growth in my market for a particular property that we are closing on next month. We underwrote it at 5%. We're not trying to be super aggressive. We're trying to go, you know, if we do more than 5%, great. But you know, anyway, I'll quit rambling.
My turn. So where do I think it's going to go? I think it's going to go double digits. Before it comes down, it will go to double digits. Here's why. In the 70s and 80s, they let inflation get all the way to 12, 13%. When they did, they took the interest rate, the Fed fund rate, they took it all the way to 12 or 13%, which was equal to inflation, and they were able to stop it at that point. Then they quickly reduced rates back down to normal, which at the time was like 5 or 6% within a quarter or two, and inflation continued to grow. So the moral to the story is right now we're at 8.2, 8.3%. I think it's going to continue to go up. I don't think anything's going to stop that from happening right now. These little tiny, piddly little 75 basis point raises that they're calling aggressive aren't even close to aggressive. I think they've been waiting for this election to occur, and then they're going to get aggressive. They have to. If they do not capture inflation, they will collapse the middle class. So they have a choice to make. Lower interest rates back down to next to nothing where it was to save the asset classes, or continue to raise rates until they capture inflation, which will increase unemployment, will put us in a recession, and will collapse the asset classes. If they don't do that, it will collapse the middle class, which is 90% of this country. We cannot afford to collapse this middle class. The government has no choice. They have to capture inflation. In order to do that, they have to get the Fed fund rate above inflation. We're not even halfway there yet. So that will take us into double-digit interest rates. How long we stay there, I don't know. That I don't have an answer to. I think once it settles, once they capture it, inflation comes down, interest rates will come back down, and I think they will normalize and settle to the long-term average, which was around 6 to 8%. Until they get rid of the balance sheet, until they get rid of all the funny money that's in this market, they cannot go back to zero. They can't. There's no room for it.
Yeah, and I don't think they'll ever go back to zero.
They will, maybe not in our lifetime, but they will, because they never learn their lesson. But I
there is
believe
that.
we'll go into double-digit interest rates, and we'll settle at long-term rates, which typically are between 6 and 8%, depending on what the market wants at the time. That's what I believe in probably the next 3 to 5 years. That's my guess. It's a pretty educated guess. There's a lot of trends that suggest that. So I'm just looking at the in the rearview mirror data to get to that point. Now, how does that affect purchasing? How does that affect underwriting? Just like anything else, the numbers have to work. The sellers are going to come around. They have a plan. If their plan involves them selling, they're going to have to come around to the prices. People are not going to buy at these stupid prices. The more the information gets out, the more the interest rates continue to rise, the smarter the buyers are going to get, the more aggressive the sellers are going to get to sell that asset before they really lose everything they've got. So the prices will come down to the market. You just have to make sure the numbers work.
So, David, so 2 questions about that. So, you think that after the election, which is, I think it's today, you think that the Fed is going to come out of left field and go up more than 75 points?
I don't know, because it's Christmas. The next one is December 21st. Now, obviously, the interest point raise isn't going to affect Christmas. Everybody's talking, of course, pre-election, 50 to 75 basis points in that December raise. I'll be shocked if it's not over 1%. They got to get aggressive. I think they may be waiting till first quarter 23 so that they can get a positive GDP growth in the fourth quarter to really try to eliminate these recessionary fears before they actually drive us into recession. They don't have a choice. They have to.
Okay. And then the second question is, when you are underwriting deals, then what I'm doing is that if I'm playing with a refinance, right? I'm underwriting it at a 7 or 7.5 interest rate and a 70 to 75% loan to value in year 3. Am I being conservative enough, or
Jason, we're already at 7 to 7.5.
Yeah.
With rates continuing to rise. And they said they're going to continue raising through 2023.
So would you make the interest rate higher on those
Yes,
refinance projections? Yes.
yes.
What would you put it at?
When?
3 years.
3 years?
refinance. Yeah.
3 years, I think 8% is probably a conservative number.
8%.
Like I said, I think it's
Steady.
gonna settle between 6 and 8%. So I'm gonna want to be on the
Okay.
high end of that.
Okay. It is 75% still loan to value, assuming that you're gonna use a more permanent refinance.
Yes.
Okay, cool. All right, thanks.
So Kiki, does that break sovereign debt though to keep raising that high? I don't know the answer to that. I don't think that our interest on our debt to the global community is tied to our Fed fund rate. It may be. I don't know the answer to that. So I don't know how that will be affected. That's why they were supposed to be reducing the balance sheet to prevent that from happening. Of course, they keep kicking the debt ceiling down the road and keep raising the debt ceiling. There was a slide on that from Casey Conway, but I didn't show it to you, how exponentially the debt ceiling has grown in the last 10 years. But they just keep raising the debt ceiling, keep raising. That's, part of our issue that we're having right now with inflation. Let's
Hey,
see.
David,
Thanks, Sean. Go ahead.
hey, are you able to share Conway's presentation or slides or anything with us? I'd love to watch that in whole, or if it's on YouTube or anything along those lines.
The recording is in the Ward Center with CCIM. But I think you've got to be a member to see it, at least to get it for free. I think if you're not a member, you can pay. They did record. Did they record? I don't remember. I think they did record it, but it was a live presentation. But I'll email me. I'll send you the slides. He don't care.
Okay, sounds good. Perfect. Thank you.
Good questions. Let's see, using your multifamily purchasing model when we get seller to give us seller financing, how do we minimize the amount we have to put down? That's just negotiating with the owner. I don't have a purchasing model. Well, maybe you're talking about negotiating, not necessarily a financial analysis model. It's no different than getting debt, only the seller holds the debt. So you need to negotiate with the seller how much they want if you're getting seller financing. I'm not sure we're there yet. We're getting closer. What you really got to be careful of is negotiating with somebody that's got short-term debt. You don't want that headache. If they've got short-term debt, they're pretty much toast. They're not gonna be able to get out of that. Garrett, so I don't do the lifetime anymore. Garrett was asking me about the lifetime price. I used to sell lifetime to the community, the education, resources, everything for $3,000. I stopped that. I've separated the course out from the community. You can actually purchase the community without the course, or you can purchase the course without the community. I just give you the trial to the community if you want to stay. After the 3 months, or if you happen to get in today, after the 6 months, if you want to stay in the community, it's $97 a month. So this is all changing as part of trying to accommodate for what's going on in the marketplace. There's a lot of fear out there right now. I can't imagine why as much doom and gloom as I talk. But I provide solutions. I don't just talk doom and gloom, I give solutions. Any other questions? We're down to 37. Thank you, Vicky. Is it lifetime access? Yes, Laura, you get lifetime access to the training. You just don't get lifetime access to the community. Thank you, Richard. Oh, you want me to post the link again? Yep, I can do that. I can do that. Paste. There you go. All right, who's got to go? Rick. Thank you, David. Great pleasure. Thanks, Rick. Appreciate it, sir.
Would you mind reposting that link, David, about the big brokerage firing people?
Okay, that's, I didn't grab that one, so let me go get it. Here it is. Stand by. Q&A is still going on, Misi. We've been waiting on you.
Sorry, I had to take on the
That's
investor.
okay. Hey, they're important. They're more important than we are.
Yeah,
That's
but I'm glad you recorded it, and I think I caught most of the presentation. So this is Q&A for the economic session you did, right? That I can ask.
Yes.
Okay. So about the pricing of the market, the cap rate, since we can't change the fact that so much money has been printed last 2 years, there's still a lot of capital circulating out there. I understand the affordability challenge, but because there's so much capital out there, I think it's going to work against the cap rate a little bit. My impression is that it won't really go down that bad, because when it comes to the cycle, what are your thoughts? Because the chart can look like really up here and really down here, and it's going to vary by region, by market, I understand, but just from a national trend standpoint, with the amount of capital having the market, so many forces working against and along each other. What are your thoughts on the amount of capital? How is that playing against the cap rate as an example?
I think as we go into a recession, the capital is going to dry up. It'll definitely dry up on the debt side. Now equity is going to be what equity is, and equity chooses their own cap rates because that's their return. If there's no debt on the property and it's 100% 100% cash down, no leverage, then you can pay whatever you want for the property as long as it works for your investors to get that internal rate of return. So in that case, that's very specialized. That doesn't happen a lot. Usually your larger institutions do just that, and they're storing capital away for when that market does occur, but they're typically opportunistic. They're not going after Class A assets. They're not going after cash flowing deals. They're going after opportunistic deals with that cash so that they can increase those rates of return. But for the general market, for the student syndicators that I like to call them, that have been in the market since 2016, or let's just say since the last financial crisis of 2008, those that have been in since then, they are not going to have the wherewithal to get into Class A cash flowing deals, all cash, unless they have some very, very, very deep investors that they've built a really, really big trust with, but then it's going to be few and far in between. That'll be very specialized. That's my opinion.
So how will the market be dried up? You're just talking about people who lose their jobs, like kind of trickling down effect?
Yeah, they have to. The Fed must increase the unemployment rate. Why do you think every time good employment numbers come out, the market goes down? Because they know as long as there's job growth, they're not capturing inflation. Interest rates are going to have to go higher. The Fed must put us into a recession, an economic recession, in order to capture inflation.
Okay. So on the job problem, you mentioned it has inflation effect, but that's more temporary, right?
What's temporary?
The job problem on the wheat.
No, the drought.
I'm not God. I don't know.
Yeah, It's just a feeling that with the weather, I mean, less, something.
A drought's a drought. Everything goes in cycles, including weather. I have no idea when the West is going to come out of that, but
Yeah.
then they got to regrow stuff. So there's going to be a large delay. So is it temporary? Temporary could be 5 years. Temporary could be 20 years. I don't know. Nobody has the answer to that.
Understand. And another question is around wages, the affordability gap.
Mhm.
How we talked about because of printing money and inflation and not, it's affordability, but eventually the wages are going to catch up slowly. And
All part of the Fed collapsing the economy is reduction in wages. Because as they start to lay people off, as jobs are getting lost, as projects aren't moving forward, wages will stagnate and then eventually decline until they start to climb again. Wage growth will not continue. It can't.
okay. It just seems like odd that, and I'm sure you have your reason, it just seems odd that if the wage isn't going to grow slowly, I guess that's where the real affordability issue comes.
Well, you and I had this conversation when we were underwriting that Tempe deal for you. I mentioned about how off the rents were for that trade area with median household income. One of the fundamentals of underwriting is paying attention to the median household income. That's your affordability for the market.
Yeah,
And we're 2 to 3 times above median household income for affordability. It's unsustainable. They can't do it anymore. And now they're not doing it. They are now moving in, they're doubling, they're moving in back with parents, roommates, siblings, cousins, anybody they can move in with because they can't afford the rents anymore on their own.
it just seems like maybe certain parts of the labor force are affecting more than others. Like during COVID time, or even last year, maybe right now it's a little different. People change jobs for 20, 30, 40% wage increases or salary increases is like a norm. And even with some of the more workforces that's lower level, maybe like McDonald's or hourly wage workers, they were also getting higher minimum wage because it was harder to find people to work. So
Yes
that
and no.
black
A lot of that was politically generated. They bowed to political pressures and went to $15, like Walmart went to $15 minimum wage. McDonald's went to $15 minimum wage. A lot of them did that through political pressure, not necessarily demand for employment. But we did hit a point right after 2020 where a lot of people didn't want to work because they were getting more money in unemployment than they were in an hourly wage. So I agree with that.
Thank you.
Yes,
That's
ma'am.
all my questions. Thank you.
Okay, good questions. Anybody else? We're at almost 8:30, 2 hours, 20 minutes.
When does your 14 module thing start?
I'm not doing it live, Kathy. It's all recorded. As
Oh.
soon as they jump in, you don't have to worry about it. You've been through it. You can go back and watch the recordings. As soon as they jump in, module 1 opens for them, and then in 3 days, module 2. But I'm not doing. I won't do it live till we get through this change because there'll probably be some changes that'll take place. So there won't be any reason for me because this was a really good recording, this last one. So I won't do it live again for a while. I got too many other things I want to do live. We're going to do a bunch of smaller classes over the next 2 quarters.
I don't know if this is real, but we were looking at a just kind of because it's related to economy, so I wanted to share. We're looking at a house. It was new built, and it was around 300, maybe 330 or 350K. And now they're saying like if you can close on something before the end of the year, they're offering to 70K. That was a big change. This was just like a month ago.
Yeah, but look how much interest rates have gone up in a month.
Yeah, and also I think it's their how they're seeing the future. The rates we're probably likely to expect another 1 or 2 rate hikes, if not more,
1 or
So-
2. Nisi, try 10 at least. I think
So,
we're gonna see 8 next year. And we still have 1 more this year.
yeah, so
You
they're.
really think that many?
Yes, they've already said that many.
Oh, my God. Hmm.
I have something to share. I'm in Las Vegas. I've been doing residential here for the last 20 years. I've done quite a few flips here. I sold my last 3 flips right around May of this year, and then I stopped buying because things are starting to go crazy. So we already have, from let's say March of this year until now, we already had at least a 10% correction. I'm talking residential here. I owned an 8-plex in the past, but that's a different story. Anyways, so residential has already went down at least 10%. And you know, back in March, the rates were like 3.5%, 3%, and today it's 7.5%. And if it's an out-of-town buyer and they're doing a second home or investment property, it's probably like 8.5. So the affordability factor has decreased. So the rates, yes, will continue to rise. But David, my thing is, as they raise rates, servicing the national debt, $33 trillion, the cost of that is going to go astronomical. There's going to be a point where they're going to realize, well, we can't afford to even service our debt anymore. So they got to have to, at some point, I don't know, maybe in a year and 2 years, at some point, they got to slow this madness down. But like you said, it's going to cause other problems. So you try to fix one area, it's going to end up affecting another area. So that's as far as rates. And then the other thing I wanted to throw out there is, if you had purchased a property, residential, let's say, in the last 3-4 years, and you have a 3% interest rate that's fixed for 30 years, well, you can't sell it. Where are you going to go? And what are you going to buy? You know what I mean? Even if you were selling this property and you make 500,000 profit on it, well, where are you going to go? What are you going to buy?
Right.
Even if it's half price, with the interest going from 3% to 7%, well, your monthly payment is going to be just as much as the prior property. So I feel like there's a lot of people stuck in that area as far as residential. Now, I don't know how commercial is. I don't know how apartments are. So the folks that bought these, 50, 100, 200 unit apartments, in the last, let's say, 36 months at phenomenal rates, why would they even sell if it's cash flowing and it's penciling out?
Because 90% of them bought it with bridge debt, short-term loans, hard money, cheap hard money is what they bought it with.
Okay, yes, that makes a huge
residential
difference.
terms.
That makes a huge difference. Okay.
Huge.
Okay.
Yeah.
Yeah, that's a big difference. Now, your course is, you said it's going to be all videos. We sign up, we just do every 3 days, you're going to do a video, and that's basically.
Some lessons, there'll be more than one video, but yeah, every 3 days, a new module opens up. But there'll be homework in between each one. I really, really, really recommend doing the homework. And
Gotcha.
the underwriting workshop will open up right away. I got to throw that in there. That'll be in tomorrow.
Now, are there active deals or deals that we can actually go out there and take a look at, or how does that work?
The community right now, I think there's 2 deals currently in the deal room. You have to search through there. We have a deal room. Some of them will put deals in the deal room. Some of them will just post them within the main part of the community. Thanks,
I didn't
Kim.
know we had a deal room.
Yes. If you'd have watched the video when you first get into the community that says, watch this video first, it tells you how to use the deal room.
Uh-oh, I better go back and start over.
Yeah, I need to do that too. I didn't realize that. So this is how you network through that deal room. You find deals, you look at apartments, you analyze deals together.
Well, if there's somebody looking for partners, yes. But you don't want to rely on other people. You want to go out and try to find those opportunities yourself. But you need to have the relationships. What I tell everybody is they want to go out and find properties right off the bat, just getting started. You're putting the cart before the horse. This is a relationship business. If you don't have the relationships to close on the property finding an opportunity means nothing. You don't have any way to close on it. You need to build relationships when you're first just getting started. That's why it's so early in my course.
Hey, David,
Sure.
sorry, just to make sure, I need to go through a couple modules again as well. They're all on the website, correct? They're not on like
Yeah,
Mighty Networks?
Correct. They're on the Kartra website.
Okay, perfect. Thank you.
Yeah. Thanks for that input, Alex. That was really good. Appreciate that. All right,
Thank
Laura,
you.
will this
You're
Q&A
welcome.
be included in the video you share? Yes, Laura. In the deal room, can I find partners who can help with money down payments? So you can find potential JV partners that would be willing to bring their own money in as long as you brought money as well. I'm not sure they would rely on just sweat equity, although there may be some that would, depending on where you live and whether that's in their market or not. And there are some passive investors in the community that you can reach out to that also help with that down payment. But now you're getting into syndication when you do that. But the short answer, Laura, is yes, but you still have to build relationships with them within the community. They're not just going to invest with you just because you're in the community. You still have to make that connection. We got one guy, well, we had 2 or 3 people. What they did when they first got in was they started direct messaging everybody to build relationships with them. Very, very smart thing to do. Well, there, I just said it. So you can go in and you can start direct messaging everybody. First, do a post, introduction post about yourself, and then just start DMing all the people that are in the community. You have the ability to do that, and try to build relationships with them that way as well.
Hey, David, quick question. Hey, sorry, similar to the others, I think I've been there for a few months, but I didn't realize this community was there. So and of course I did not listen to that video that you were alluding to. So I am guilty. Yes, I got to do that. But is that community on Facebook, or what is the forum where we?
No, it's on Mighty Networks. Facebook sucked.
Okay. So I got to download that or access
We
that.
tried Facebook, took it off Facebook, tried Slack, took it off Slack. So now it's in Mighty Networks. We've been in Mighty Networks it's been almost a year. We've been in Mighty Networks. We like it. We like Mighty Networks a lot.
All right. Thank you very much.
Yes, sir. So forget the email I sent you, because if you're already in, you don't need to pay for anything else.
Yeah, but I'm on the monthly packet, so I've already have, yeah, appreciate it.
Oh,
But I'll set up time with you anyway next week,
Yeah.
so we'll
set
talk.
up a time to talk.
Thank you.
Okay.
Appreciate your help.
Yes, sir.
So for in the lesson you mentioned about there is a chapter teaching about how to find off-market deal. Do you support the tool, or do you recommend what should we use to target the off-market deal?
I give you contact lists of all the property owners that are listed in CoStar. Not all of them are listed, but what are listed for the market that you want.
Got it.
So you
Thank
don't
you.
have to go pay for anything else. Anybody else? Good question, man.
As we go through those classes, is there going to be like a weekly or a monthly live session with you, or?
Every Thursday night we have Q&A.
Okay.
Every Monday night we have goal setting.
Goal setting Monday night.
Yep.
And then
Monday night goal
Thursdays.
setting, Thursday night Q&A. The only exception is if I'm traveling or I'm sick or it's a holiday.
Right.
Those are the only
Okay.
exceptions.
And the classes are like, so every week one opens, but it's basically self-paced
It's
to go through the modules.
correct.
Okay.
Let's see. Laura,
Thank you.
are we limited in the number of markets we can approach? Will you share owners from CoStar? So yeah, Laura, you could get owners from multiple markets, but I want to caution you on doing multiple markets. You should really try to focus and pick 2 or 3 markets. Jason's my poster boy for choosing markets. He's in 2 markets, Indianapolis and Kansas City, and he's totally focused on those markets and he's finding opportunities. The problem by doing too many markets is, thanks, Ahmad, is you don't have the time for follow-up. And without follow-up, you're never going to find the opportunities. Thank you, Misi.
Thank you, David.
Did that help, Laura? I don't know if you're still on here. Yeah, she's still here. What else, guys? We're down to 25. So we'll go 7 more minutes because my stomach is starting to growl. And I'm keto, and your stomach never growls on keto. So that means I must really be hungry.
You've been on keto a long time, haven't you?
2 weeks from today will be 3 years. I went on it November 22nd, 2019. I know that date because it was my daughter's birthday and it was 3 days before Thanksgiving.
Gosh, that's amazing.
So, David, very funny story is that I have been a vegetarian since 2011, and I just started eating meat again a couple of weeks ago because I'm trying to put on more muscle. So.
Yeah. Yeah, I one of the VP of education for CCIM. He's not a CCIM, he's staff, but he's in charge of the education division at CCIM. Him and I have become really good friends. He actually wrote a book on keto. And we've got another friend of ours that is vegetarian. And so we always tell him when we go out to a restaurant, you order all of the meat and we'll order all the vegetables and we'll share. So he gets, because we can't eat we can eat the green vegetables. We can't eat fruit, no pastas, none of that. He can eat all that stuff. So we get all his meat and his fats and the things he doesn't like, and we give him all the stuff we can't eat because of the natural sugars within them. Works out well. I get asked all the time, don't you have a hard time going to restaurants? I'm like, nope. Doesn't matter the restaurant. I can always find something to eat. I might have to build my own menu, but I can always find something to eat.
So you mentioned about the during the interest rise, we're expecting that the interest rate is going to rise further, and the bank, it's very hard to get a loan from the bank right now. And as a matter of fact, I received one of the OM from one of my brokers that I talked to last week, that with his underwriting, the down payment assumption is 35%. This is the first time that I ever seen. So does that, I didn't have a chance to ask him, but do you think that is reflecting that the bank is doing what they're doing right now?
Yes. So prior to 2018, the strategy was to get into a deal that you acquire and put agency debt on it right away. With agency debt, you get a period of anywhere from 2 to 5 years interest only. So you would use that period to do your value add, and then you would sell the project at the end of 3 to 5 years to the next investor that would assume the debt, because with agency, you've got a large prepayment penalty. So investors were coming in and purchasing at 35 to 55% down because of the appreciation from the asset, from the value add play, the forced appreciation. This was prior to actual price appreciation. It was still forced appreciation at the time. And the strategy was to be able to acquire the new, or to acquire the property with the existing debt, an assumable loan, which is why agency was perfect for that. So now, because short-term debt is not an option, and because interest rates are doing what they're doing, these permanent loans, because really nothing from about 2018 or 2019 to now, almost nothing has been purchased with long-term debt. It's almost all been purchased with short-term, and with very, very, very low interest rates. Again, those people are toast. Prior to that, they were bought with that agency debt. So now those that bought with agency debt are sitting about 5-6 years, anywhere from 5 to 10 years, and they're trying to get out before the recession hits. So they're now selling with their assumable loan, and the interest rates that we're seeing are somewhere between 4.5% and 5.5%, which is still, 200-300 basis points lower than what you can get on a new loan. But you got to come in because they still want these just absolute stupid pricing. You got to come in at freaking 45-50% loan to value in order to get it. You can't get a supplement because the deal doesn't work with a supplement, and the lenders are being very, very picky about who they will give the assumption to. So yes, man, that strategy is back on the forefront because of what's going on with interest rates. That was a very long way to answer the question.
Thank you.
Good question. Everything I'm hearing, Garrett asked, that's GT Todd for those that don't know, his name's Garrett, asked if I think the recession is going to be worse than 08. All the smarter people than me have told me it's going to be worse than 08. Just too many global factors.
So following up on that topic, I came back at a thought of another question. Following up on that topic, the home prices correction to 829 was anywhere between 50%, 30 to 50% or more. With the supply and being a differentiating factor, we do have supply shortage across most of the major metros, and with that being consideration, and also we do have money that we printed, we can't just have the federal government taking back. How much of a correction in terms of single family houses do you think it will see at the bottom of the cycle? And that's very specific. Just give, what do you think?
I have no idea. Single family is not my market.
It's not a market, but it affects
but if you remember, single family caused the financial collapse through mortgage-backed securities and subprime debt in 08.
Yeah,
It's going to be commercial this time. It's not going to be residential. That's going to cause this crash. What do you think a bridge loan is?
yeah, I understand the changes in the
Bridge loan is considered a subprime mortgage. And 90%, probably more than 90% of all multifamily, I don't know about it in retail and office and all the rest of them, but in more than 90% of all assets that have been purchased since 2019 have been purchased with bridge debt in the multifamily space, in the larger multifamily space.
I have a question. Is there anyone here on the call that is currently a limited partner on a deal right now, where if you know that they're having trouble and you might be getting a capital call soon?
I've already seen that a few times just in the last couple of months.
I just wonder if anyone is experiencing that right now.
I'm not, but a friend of mine's getting a capital call. Who's involved in a place, I think it's in Texas.
And what do you know the underlying reason?
I don't know the details.
I think, I mean, a property that I'm on in is struggling very much. And I think we are looking at a capital call coming up. So I'm just wondering if this is what's going to be happening all over the place.
And that's not what you got to worry about, Kathy. That's going
What?
to happen. What you got to
Okay.
worry about is when the bridge lender calls the loan due.
Yeah.
That's what you got to worry about.
Yeah. Not looking
I got
good.
3 more minutes and then I'm going to shut it down.
Thank you very much, David. This was wonderful.
Thanks, Kathy. This was
Thanks,
fun.
Dave.
Thanks, Richard, and welcome, sir.
Thank you, thank you.
Thank you, Misi.
Thank you.
Thanks, man.
Thank you, David. Looking forward to working with you, sir. I just signed up.
Thank you, Alex. Appreciate it.
Absolutely. You guys have a good night. Thank you.
Thanks,
Hey,
Jen.
Alex, nice talking to you, and hopefully we'll see you around. I just signed up too.
Don't forget to save the chat, everybody.
If you don't, you're going to get it in an email tomorrow, so it doesn't matter.
Oh, okay. All right. Bye, y'all.
Bye, Kathy. Good seeing you.
So we'll get further instructions from you, David.
Yeah, you're going to get an email with instructions, and I'll go in if you buy tonight, and
I already did.
which you did. Yeah, I see it. And I'll go in and extend the additional 3 months.
Dave, did mine go through?
I got, let's see, who's this one?
I was on it and I don't know if I
On.
pressed the entire button. It
No,
just went off my
yours
screen.
didn't go through yet, Richard.
Okay, I gotta find that link again, damn it.
You want me to post it in the chat again?
Yeah, it'd be easier. Thanks.
There you go.
Thanks, you guys. Have a good night.
Thanks, Alex. All right, 1 more minute and I'm gonna shut her down.
Oh, see you, David. Thank you again.
Bye, Jason. See you Thursday night. What's the amount of managed first people get it? Laura, honestly, it depends on the market. It depends on the person, their partners, their relationship building, how much work they put into it. I've seen it as fast as 3 months, and I've seen it take as long as 3 years.
If you want a good example, I've been on the market for 11 months.
Yeah, I got my first one in 9 months, I think, when I got started. That's a really tough question to answer. All right, everyone, it is 20:45 or 8:45 for you US folks. Although I'm US, I'm just like talking global terms. Have a great evening. Thank you for coming. And we will see those on the inside that are coming in. And other than that, look out for the next masterclass, which will be in 2 weeks. Have a great evening.
Thank you,
Bye,
David.
Have a good evening, everyone.